morning, friends. So we are doing the chapter dividend policies. Today we will complete the chapter. So we have the following issues to be covered: residual dividend policy, Linter's model, then one case study type of problem applying the various issues studied in this chapter. When one examination problem testing the NPV and dividend impact on share valuation. Then we'll be completing the chapter with two buyback problems. All these issues we'll try to complete in today's class. Next class we'll start with the very important and main chapter called as portfolio management. Let us summarize what is done in dividend till now before we proceed further. Those who come late, please without noise settle down, please. We saw that companies raise finance, invest in assets, generates returns, and the return generated will be used to service the finance providers. Here, how much should be given to debt is predetermined through indenture. But whether the profit should be given to shareholders is a decision the company has to make. This is what we refer to as dividend policy. The main theme in this chapter is how the dividend policy affects the share valuation, or does it affect the share valuation. Yes is what the theories of relevance said. No is what the theories of irrelevance said. Theories of relevance are Walter and Gordon, and irrelevance theories is Modigliani-Miller approach. What Walter says is that find out the R and KE. KE is the expectation of the shareholder. R is the IRR of your proposed projects. If the R is greater than KE, then you are able to earn more than what they want, then keep their money. If R is less than KE, you are not able to satisfy their expectation, return their money back. Declare dividend when R is less than KE, and retain when R is greater than KE, indifferent when R is equal to KE. Here they found out the share price using the following formula: P0 is equal to D plus R by KE into E minus D all divided by KE. Gordon says, yes, Walter is right, it affects the share price. But we have two angles to the retention as well as dividend. When we retain money, the advantage is it propels growth. But at the same time, retention increases the risk to the shareholders because they feel that a current income is more certain than a promised growth through retention. So increased retention increases KE, but increased retention also increases the growth. And it is vice versa for dividend. Gordon says optimum payout happens where the share price is maximum. He values the share using the formula P0 is equal to E into 1 minus B divided by KE minus BR, where E is the earnings per share, B is the retention ratio, 1 minus B is the payout ratio, and KE is the discount rate, B into R is the growth rate. Growth depends on how much you retain and how much you earned on the retention, B into R. Next, we discuss about Modigliani-Miller approach, where MM says that whether you declare dividend or not, dividend per se will not be affecting the share price. What affects is only your investment opportunity available. Neither your financing decision nor your dividend decision has got an impact over share price. Only investment decisions affects the share price. He proves his irrelevance by saying that even if you declare dividend, if there is a good project, company will do it by raising the additional money through new shares. A receiver of dividend enjoys that dividend, at the same time is going to have a dilution in the share price. It is going to be vice versa. The wealth of the investor will not change. For company also, what goes out as dividend comes back as what? Share price. Money goes out and money comes in. There is going to be no change in the wealth per se, except that the same wealth is going to be shared by more number of shares, that's all. He proved the irrelevance using the formula NP0 is equal to P1 into N plus M minus I plus E whole divided by 1 plus KE, where the number of new shares to be issued, MP1 is given by the formula I minus E minus ND1. This is regarding the dividend policy under Modigliani-Miller approach. Once we discuss that, we discuss about the rights issue. Rights issue means when a company wants to raise further capital, the opportunity should be given to the existing shareholders. Only when they say no, we can go outside, they can go for the public issue or any other way of raising the finance. When a right is given to the existing shareholder, they have got two options. One is to exercise the right and buy the share. Another is to sell the right in favor of another party. If it does nothing, then the wealth of the shareholder gets reduced. So in those cases, there are two things that needs to be understood. What is the ex-right price and what is the value of the right? These are the two calculations in any rights issue problem. Ex-rights price is the price after the rights issue is over. It's very simple. Number of shares before the rights issue into the market price per share gives you the current wealth. And number of shares newly issued into the amount which you are going to get is going to give you the new wealth. Current wealth plus the wealth brought by the new shareholder gives you the total wealth divided by the old shareholders plus new shareholders. When I say new wealth, I said the amount brought in by the new shareholder. If I don't know anything about the investment, if they give you the reinvestment rate that the rights money is going to be invested at 15% and the shareholders want only 12.5%. In such a case, the new investment is going to have an NPV also. So how we calculated the amount brought in into R divided by KE. We did the second sum. It's or no. In that case, the share price becomes increased due to the NPV arising on account of new investment to be made out of rights issue. Then the rights price or the rights value is nothing but ex-rights price minus subscription price. A person who is going to buy the rights share is going to get a share worth ex-rights price. He is going to pay only the subscription price. The difference will be the value of the right which a person getting the right has to pay to the giver of the right. I cannot explain more. We explained one full class, last class, only relating to the rights issue concept along with so many notes which has been dictated regarding the second sum which we did in rights issue. I think up to this we completed the chapter. Right or not? Now let us quickly go through the remaining parts of the chapter. Okay. Now give the heading residual dividend policy. Give the heading residual dividend policy. Shall I start? No. Nothing great. What this policy says is that after using money for whatever you want, any balance left, give it as dividend. That's all. Concept over. Okay. So shareholders are like a beggar. Okay. After everybody eats, something left will be given to beggar or not? Like that. Your investment needs, everything will be there. After using everything, if something is left, give it as what? Dividend. That's all the concept over. It is called as what? Residual dividend policy. Okay, see. To be more serious, what companies always do is, suppose I want 100 crore rupees for a project. I want 100 crore rupees for a project. I can raise the money either to debt or owner's money. Never read. You can raise the money through debt or equity. Every company will maintain a constant debt to equity ratio. Every company will maintain a constant debt to equity ratio. For example, my company maintains 2:1 debt to equity ratio means for every 1 rupee owner's fund, they will always be having what? 2 rupees borrowed fund. They will never change this ratio because debt to equity ratio communicates the financial risk of a company. Right or not? How much you are levered is indicated through the debt to equity ratio. If you keep on changing it, this year it is 2:1, suddenly becomes 3:2, then becomes 1:3 and so on, then the shareholder does not have a certainty regarding the capital structure or financing pattern of a company. So no, number one is businesses, what new project going to take is going to change the risk profile of the company. That is understandable. But every now and then, you should not be keep on tinkering about your capital structure. Good companies always maintain a constant capital structure. 60% debt, 40% equity means whatever project they do, they raise the money only in what ratio? 60 and 40. Suddenly everywhere bond market interest has dropped. Okay, debt is available cheap now. Just because for that they don't jump on what? Go for more borrowing. They always maintain what? The constant debt equity ratio. This is done to gain the confidence of the shareholders. Are you following not? Because business is not alone about the cost savings or profit increase. It is all about how confident you are in the eyes of the shareholders. Trust is very, very important. Companies should not keep on changing the capital structure. So companies will be having a policy regarding capital structure saying that my capital structure will be always what? 60% debt, 40% equity, or 40% debt, 60% equity, and so on. Everybody following up? Now, when a new project is going to be started, 100 crores is required. Suppose my ratio is 60% debt, 40% equity. 60 crores I am going to surely borrow. Are you following up? I am going to borrow surely what? 60 crores. In a debt equity ratio, and balance 40 crores should be owner's money or not. I have two options here. One is I can use the retained earning. There is also shareholders' money only, or I can go for a public issue and not. Now, whatever possible, I use the retained earnings, and the balance will be gone for the public issue. And in residual dividend policy, after contributing towards a retained earnings portion, any amount left, the amount left can be declared as a dividend. Okay, and learn by actually doing a problem in this regard. Two problems will be doing. One, a CA examination problem, very simple and straightforward. Another is an ISAA final examination problem that really captures the spirit of the residual dividend policy. We can understand this much more better with the help of a problem. Okay, before I start, tell me, companies maintain what capital structure? Constant capital structure. Can they keep on changing it up? No. The confidence will be lost on the company's way of running the business. So any new project, they try to maintain the same financing structure. In that equity portion can be financed either through new issue or through what? The retention. First option is to go for the retention, and balance can be gone for the new issue. Up to this, are you following not? And after financing the project, any money left out can be declared as dividend. Is what this residual dividend policy states. Can we start doing a problem or not? Now, please take question number 6. Take question number 6. Axel Telecommunications has a target capital structure which consists of 70% debt, 30% equity. What is the meaning of that? Whenever they want money, they go for how much borrowing? 70 rupees. How much owner fund? 30 rupees. The company anticipates, H is missing here, the company anticipates that its capital budget for the upcoming year will be 30 lakhs. If Axel reports net income of 2 lakhs and it falls 20 lakhs and it follows residual dividend policy, what will be its dividend payout ratio? Very simple, one of the exam problem also. Can you start or not? Now. Okay. Tell me, how much money is required for the investment? Answer, how much is required for investment? 30 lakhs. This 30 lakhs money, how to fund it? Can I borrow the entire 30 lakhs or can I use the entire owned funds? No, I have to go for what ratio? 70-30. So for the new project, I have to raise 30 lakhs. I propose to raise 70% of it. How many days here? 21 lakhs through debt and balance what? 30%, 9 lakhs through equity. This is 70% debt and then what? 30% equity. Respond yes or no? Now, next is 9 lakhs should be the owner's money or not. Always understand that I can get the money from the owner by using their profit. Yes or no? Using the shareholder's profit is as good as getting money from the shareholder, right or not? Retained earnings is also what? Money belonging to the shareholders. Another way is to give them dividend and raise fresh issue. And raise what? Fresh issue. Okay. Mardigilani Miller says both are same. You give them dividend and then raise money, or what? Use their money. Both are going to be what? Same. In reality, both are not same because retained earnings is cheaper than getting a new issue. Are you following? Very simple. Your 100 rupees belongs to me. Your 100 rupees belongs to me. I can use that 100 rupees, or I can give you the 100 rupees as dividend and raise from you back what? 100 rupees. In the first case and second case, you expect the same return. That is okay or not? You want 14% return from that investment, means my KE is 14%, right or not? Your 100 rupees when I use, I should satisfy you by earning how much percent? 14%. If I raise from you the share capital also, I'll say I have to have how much percentage? 14%. That is not a change. But when I distribute the money and then get it back, the problem is, number one, when I distribute the money, I have to pay dividend tax. Yes or no? I have to pay what? Dividend tax. That is one disadvantage. Forget about that. It may not be there in all the countries. Even if there is no dividend tax, when I raise the money from you, I have to go for issue expenses. That's going to be what? Flotation cost. Always raising money through new issue is having a cost of capital which is much more higher than what? Using the retained earnings, because in retained earnings there is no flotation cost. When I raise the money from public issue or any other area, I have to incur what? Flotation cost. Due to that, always company prefers to use what? Retained earnings. What is not available only, they'll go for what? Public issue. Everybody yes or no? If KE is equal to 20%, KR, cost of retained earnings, will not be 20, will be more than 20 or less than 20, less than 20 due to absence of flotation cost. Everybody, are you following? No. So in that case, 9 lakh rupees should be given by the equity holders or not? Tell me. Unlike Mardigilani, will I distribute and then raise? Use the retained earnings. Use the retained earnings. So now tell me, how much is the net income available? 20 lakh. In it, surely I set aside how much lakhs? 9 lakh. For what purpose? Capital budgeting purpose. And the balance what? 11 lakhs can be given as dividend. Everybody yes or no? And what is the payout ratio? The answer very simple. Payout ratio is equal to 11 lakhs out of how much? 20 lakhs. I give it as dividend. What is the payout ratio? 55%. That is 55 rupees out of 100 rupees profit is given as dividend. Is answer for this particular sum. Everybody following? Now, when I do this sum, answer is very simple. Answer is very simple. Yeah. I had how much? 30 lakhs required, in which I have to borrow 21 lakhs. 9 lakhs should be from owner's money. In 20 lakhs profit, 9 lakhs used for investment purpose and 11 lakhs distributed as dividend. The payout ratio is 55%. The sum angle is over. Yes or no? But during this discussion, I convey 2 extra points. Number one, companies always like to maintain what? Constant capital structure. I gave the reason because capital structure certainty gives you a certainty in the financial risk angle. Always you should not be uncertain both in asset side as well as what? Liability side. Asset side nobody can prevent it because business are always volatile. Yes or no? Liabilities at least one should maintain a consistency, otherwise trust will be lost in the company from the shareholders angle. Business mainly runs not on profits but on what? Always understand that your profit creates trust, but trust is much more than what profits. So business is not trust only. In that case, constant capital structure is very, very important. Is one point we have learned. Yes or no? Point number 2, we reviewed Mardigilani Miller. MM assumes that there is no flotation cost. Perfect market assumption as studied in IPC, that is assumption of what? But really, using retained earnings and giving dividend, getting back money, both are not same. Because giving dividend, getting back money involves some extra cost called as flotation cost. Is absent for what? Retention. Always residual policy says use retained earnings first. Balance should be given as dividend. Don't declare dividend and then raise the money once again. Is what this particular resident dividend policy says. Everybody following or not? Now, please copy the solution quickly before you go for the next sum. Write down. Capital required 30 lakhs. Capital required 30 lakhs. branch it into 2. Capital required 30 lakhs, branch it into 2. 21 lakhs, 9 lakhs. Capital required 30 lakhs, branch it into 2. 21 lakhs and 9 lakhs. 21 lakhs, 70% debt. 21 lakhs is 70% debt. 9 lakhs is 30% equity. 30% equity. Can I proceed or not? Next. Net income 20 lakhs. Net income 20 lakhs. Branch it into 2. 9 lakhs, 11 lakhs. Net income 20 lakhs. Branch it into 2. 9 lakhs, 11 lakhs. 9 lakhs required for capital budgeting purpose or investing purpose. Both are same. Required for investing purpose or required for capital budgeting purpose. Tell me balance 11 lakhs, what I am going to do? Available for dividend purpose. Available for dividend purpose. Can I proceed or not? Next. Payout ratio is equal to 11 lakhs divided by 20 lakhs. Out of 20 lakhs I declared 11 lakhs dividend. 11 lakhs divided by 20 lakhs is equal to 55%. 11 lakhs divided by 20 lakhs is equal to 55%. Payout ratio is equal to 55%. Write down notes. Write down notes. Companies should always try to maintain. Companies should always try to maintain. Companies should always try to maintain a constant capital structure. Companies should always try to maintain a constant capital structure so that it has a consistent leverage policy, and a certain financial risk. This word certain is dictated now. Don't misuse it or understand different. Certain finance is not like that. Certain means what? Sure. It has a certain financial risk. Point number 2. Companies which keeps on changing regularly. Companies which keeps on changing regularly its capital structure. Companies which keeps on changing regularly its capital structure loses the trust of its investors. Companies which keeps on changing capital structure regularly loses the trust of its investors. And thereby its share price gets adversely affected. And thereby its share price gets adversely affected. Can I proceed or not? Next. Point number 2 or 3? 3. When a new investment proposal is available, the equity portion of financing the equity portion of financing, the equity portion of financing. Any investment available, debt will finance a part, yes or no? The equity portion of financing should be first done using, the equity portion of financing should be first done using what? Retained earnings. Should be first done using retained earnings. Should be first done using retained earnings rather than distributing dividends. Should be first done using retained earnings rather than distributing dividend and raising fresh issue. Rather than distributing dividend and raising fresh issue. Rather than distributing dividend and raising fresh issue. Because KR, tell me what is KR? Cost of retained earnings. IPCC na? So KD means what? Cost of debt. KP means what? Cost of preference. KE means cost of equity. Like that KR. Because KR less than KE. Because KR less than KE. KR less than KE due to absence of KR less than KE due to absence of what? Flotation cost. KR less than KE due to absence of flotation cost. Due to absence of flotation cost. So these are the two extra points you have learned in this particular problem. Can I proceed or not? Now take the next question. That's a very good problem. Take question number 7. Take question number 7. A Limited has made a profit of rupees 1 lakh. Please, all of you, has made a profit of rupees 1 lakh. Its gearing ratio is 0.4:1. Tell me what is the another name for gearing ratio? Debt equity ratio. It is called as leverage ratio. It is called as gearing ratio, debt equity ratio. All are what? Same. Tell me what is debt equity ratio formula? Debt by equity or debt is to equity. When I say debt equity ratio is 0.4:1, please read out for me. What is the meaning of that? Yeah? If my capital is 1.4, if the capital is what? 1.4, it will comprise of 0.4 borrowed money and 1 rupee owner's money. Everybody, are you following or not? No. The cost of capital is debt 10%, retained earnings 20%, equity 23%. I have a doubt. Retained earnings and equity, both are shareholders' money. The new equity share also shareholder. Retained earnings also what? Shareholders' money. For both the money, they should expect the same return. Nah? They should expect same return. Yeah? Because my money, whether I give out of my pocket or you keep my money, for both I have to require what? Same return. Why retention is having a lesser required return compared to equity? They may require same return, but in equity have to incur also what? Flotation and other costs. So KE will become more than what? KR. In some circumstances, everybody, are you following or not? Now, so the KE is 23%. 4 projects are under consideration. Project A requires an investment of 1,12,000. Its IRR is 19%. Project B 56,000. IRR is 18%, and so on. They have given. What amount would be paid as dividend? What would be the CDT? I think CDT now is 16.995%. Surcharge change is 16.995%. I just put the old calculation. When you do, we'll just want to recalculate it. Can I proceed? So this is going to be the problem. Okay, one of the ISAA final examination question. A good sum will capture the spirit of residual dividend policy appropriately. Can I proceed or not? No. Tell me. What is the money available? What is the money available here? 1 lakh. This 1 lakh belongs to whom? Shareholder. This 1 lakh I call as the profit after tax or amount belonging to shareholders. Other details are given regarding cost of debt, cost of preference and cost of retained earnings and cost of equity. Projects available also is given. The question is, how much will you pay as dividend? Is that my question? What is the question? How much will you pay as dividend? Can we start or not? No. See, I will accept a project if it is good. I will reject if it is bad. Am I right? Yes or no? Sollupa, are you really awake or not? No. Project A gives 19% return. Is it good project or not? We cannot jump and say like that. The project gives you how much? 19%. This is a return on investment. Yes or no? For that, a capital of 1,12,000 is required or not? That's going to be a cost of capital. Yes or no? For every ROI, that's going to be a cost of capital because capital only gives you what? Investment. Investment generates return. Capital pays what? Cost. Always from IPCC you have learned that accept if IRR is more than cost of capital. Reject if the IRR is less than what? Cost of capital. Respond yes or no. What is cost of capital? The expectation of the fund provider. Don't say the shareholder's expectation. If debenture provider gives a capital, it should be what? KD, cost of debt and so on. Respond yes or no. Now, in this question, my cost of capital is KD or KE or KR, all the three. Because I am going to use what? Mix of financing. In that case, the cost of capital is not cost of debt, nor it is what? Cost of equity, nor it is what? Cost of retained earnings. I am going to use what? Mix of financing. In that, I use a weighted average cost of capital, IPCC portion. WACC, weighted average cost of capital. How you calculate source of capital, then the proportion I write, then write the respective cost, and then write the weighted cost. Don't make me teach WACC here. It is already done in IPCC. You all remember or not? Okay, anything if I want to speak, I am afraid always to speak, whether you know it or not. Can I say? So now we have to calculate the weighted average cost of capital. Can we start or not? No. Can I use full debt? No. Can I use full equity? 50-50? What should I use? 0.4:1 should be the proportion. Okay. When I say equity shareholders money, my first preference is equity issue or retained earnings. That is always what? Cheaper. So now let us see the equity financed by retained earnings. What will be the cost of capital? And then proceed with our discussion. Can I start or not? Now. Look at this. Calculation of weighted average cost of capital. This calculation I am going to do very frequently in the next chapter portfolio, also mainly in the equity valuation chapter later. Get used to it. Can I proceed? Now, source, amount, proportion, cost and weighted cost. Can I proceed or not? Now, first, two sources, retained earnings and then debt. I don't bring the new issue now. Let us take what? These two, retained earnings and then what? Debt. Retained earnings is known. I can maximum retain, how much rupees? How much is here? 1 lakh. I can maximum retain 1 lakh. If you have 1 lakh retention, again I can go for borrowing or not? Can I borrow 1 lakh? If I borrow 1 lakh, then for the new project financing and all, the debt equity becomes 1:1. Yes or no? But how much can borrow? 40,000 because 0.4:1. If the owner money is 1, the borrower money should be what? 0.4. Is a constant capital structure. Right or not? In that case, with the help of retained earnings, I will be able to raise how much finance here? 1,40,000. Retention 1 lakh and the borrowed based on what? Retention is 40,000. Can I proceed? Now, proportion 1 lakh by 1,40,000 is 0.7413. 40,000 by 1,40,000 is 0.2857. Yes or no? Now, what is the cost of retained earnings? 20%. The cost of debt is 10%. 20 into 0.7413, 10 into 0.2857. If I see the weighted cost is 17.15%. Now, just for my satisfaction, I'll explain the WACC and then proceed. Because those who are not known WACC, I have to explain it or not. Now, very simple. Entire money I raised through debt. What is my cost? What is the cost here? 10%. Entire money I raised to equal as a retained. What is the cost? 20%. That means if I raise 50-50, for 50% of my capital, the cost is what? 20. For another 50%, the cost is what? 10. The overall cost is 0.5 into 20 plus what? 0.5 into 10. I take the average cost of capital. Yes or no? This average is what average? Weighted average because the proportion changes. Everybody following out? Either we call as the weighted average cost of capital. Answer my question. With retained debt, debt equity, investor equity is what? Retained earnings and debt is borrowing. In this combination, I will be having a cost of capital. How much percent? 17.15%. Look at your workbook and tell me, are there any project which are giving a return more than 17.15? Yes. What projects? A and B. C and D less than that. So what I can do? I can reject C. I can what? Reject D. Here I just want, people may say, sir, C giving 16%. I can borrow how much percent? 10%. Why can't my capital be what? Borrowed capital. Do that particular project. Temptation will be there. Right or not? Like this, in business, temptation will be there because borrowing may be cheaper and the IRA is what? 16%. Remember that the 10% you have to surely pay interest. 16% may be got, may not be got. In that case, your financial risk increases or not? Now, company will come across such situation where the borrowing cost may be cheaper than what? Available project. They should not be tempted to fully finance the project to what? Debt and do it because it will disturb their capital structure. Or you'll find what I'm saying. I will have a financial discipline where even if some good projects are coming, if it is not meeting my capital structure now, I should reject it. Or you'll find what I'm saying. In that case, tell me 16, 14 should be accepted or rejected? Rejected because less than my weighted average cost of capital or WACC. These two should be rejected. Point number 1, accepted. Now, what projects are available now? A and B. Now, please add and tell me, A and B is requiring how much money? 1,68,000. How much money is required? 1,68,000. A and B requires 1,68,000. But with this capital structure of retained earnings and what? Debt, I have only how much? 1,40,000. If I want more money, that should be raised through what? Equity issue and borrowings. Yes or no? There also that 0.4:1 will what? Come. And raised through what? Equity issue and borrowing. At that time I cannot say the WACC will be what? 17.15. It will be changing because the KE is not equal to KR. It becomes 23%. Ennappa, right? Yes or no? In that case, what should be the next stage? One thing is sure. First, from this, A and B has IRR more than what? WACC, hence qualifies for the selection. But for doing B, A no problem. 1,12,000 money available or not? Yes. But for doing B, additional amount also needs to be raised through equity. So now, for comparing B's IRR, I should not take the 17.15 as cost of capital because B needs to be financed even using what? Equity issue. Can it withstand it is the next issue. I will find what I am saying. So now I am going to recalculate WACC and see how it is going to happen. Can I move to the next stage or not? I will just write in the sheet the recalculation and then go for the slide. Now let's go for the WACC calculation once again. Before let's see how it is going to be raised. Okay. Total fund required is how much? 1,68,000 for doing A and B. C and D outright rejected. Okay, A already selected. That's what I'm saying. So how much is 1,68,000? In this 1,68,000, I should use it for what? A as well as what? B. Tell me, A how much is required? 1,12,000. B how much is required? Every project should be independently meeting my capital structure norms. Can I say or not? No. In that case, A 1,12,000 in this, A should be having debt as well as what? Equity. How much? In the ratio 0.4:1. All in the ratio what? 0.4:1. You want to write it here? 0.4:1. Okay. 1,12,000 divided by 1.4 into 0.4. Somebody tell me the number. What is the number? 20? Equity? Okay. 80,000. That is 32,000. Everybody following up? Very simple here. 1,12,000 divided by 1.4 into 0.4 gives you debt. 1,12,000 divided by 1.4 into 1 gives you what? Equity. Now, this is going to be borrowed and this 80,000 come from what? It comes from retained earnings. 1 lakh profit available, 80,000 of the retained earnings goes to what? A, and balance only 20,000 available for what? B. Up to this I can have the clarity or not? Now, come to 56,000. This should be through debt, equity, debt and equity, debt and then equity. In what ratio once again? 0.4:1. Tell me what is 0.4 of 16? 16,000 and then what? 40,000. Okay. 0.4 by 1.4 into 56. 1 by 1.4 into 56. This is going to be the borrowing. Tell me, in this 40,000, I have two options. One is what? First, I will use what? Retain. And second, use what? Equity issue. Okay. What is retained earnings available here? Out of 1,80,000 gone. What is the balance? 20,000. And what is equity issue? 20,000. Respond. Are you following not? No. One thing. For this, the WACC is 17.15%. Correct? This is a 0.4:1 debt equity mix, where the equity is what? Retained earnings. Always 0.4:1. The WACC is how much? 17.15%. Respond is or no? But for this, will the WACC be 17.15? Not at all, because the proportion is 16,000 rupees debt, 20,000 rupees retention, and 20,000 rupees what? Equity. For this proportion, new WACC should be calculated. Innappa, right or not? Now, up to this, clarity irka? Okay, now. I have to put the slide now. So just remember this number before I go for the slide. If you all are concentrating, tell me what is the money totally required? 1,68,000. In which A requires 1,12,000. B requires A 1,12,000. Debt equity ratio is what? Debt is what? It is 32,000. I also seen. And equity is what? 80,000. Remember, debt is 32. Equity is what? 80,000. That equity comes from new issue or retention? Retention. After doing A, I have still 20,000 rupees left for retention. Yes or no? Now, B requires 56,000 or not? You say debt is what? 16. Equity is what? 40. In the 40 owner's money, 20,000 comes from what? Retention. And 20,000 comes from what? New issue. Project A, WACC is 17.15 because the debt equity is debt issue retention. Yes or no? For project B, it need not be 17.15. It should be obviously more. How much is going to be calculated now? Innappa, right? Now let's go for the project B WACC calculation. Please. Calculation of WACC for project B. Okay. What are all the source of financing? Equity, retention, debt. How much is equity? 20,000. Retention? 20,000. Debt is 16,000. The total is how much? 56,000. Next. Proportion 20 by 56 gives you 0.3572. Believe me. Next, don't calculate. 0.3572 or 71 rounding off has been done. 16,000 by 46 is how much? 0.2857. Cost of equity 23. Retention 20. Debt is 10%. The weighted cost is multiply. I get the WACC as 18.22%. What is the cost of capital? 18.22%. What is the IRR of B? Tell me. 18%. Should B be accepted or not? No. If retention is only the source of financing, B can be accepted, but B cannot withstand a flotation cost also. Are you following what I am saying? In that case, I have decided out of the 4 projects A, B, C, D to do only what project? A. The decision is over or not? In that case, when I do A, how much money is required for A? 1,12,000. I am going to borrow how much? I am going to borrow how much? 32,000. What retained earnings? 80,000. Out of 1 lakh, 80,000 is going for what? Capital budgeting purpose. Resident dividend policy says that what is available is how much? 20,000. Declare as dividend. Yes or no? But the entire 20,000 cannot be paid as dividend because I should pay dividend subject to what? The dividend tax. Enna right or not? So CDT, corporate dividend tax. Okay, tell me why CDT is levied here? Our subject, it is our subject only. See, already I pay tax na, PAT. Company pays tax, balance only available to shareholder. That means I am an investor, I invest in the company and company earns for me and pays also the income tax and balance PAT only they give me dividend na. On that once again can I charge tax? That is the question or not. See, on interest and all, the company claims a tax shield, then I have to pay what? Tax. Dividend exempt from tax, okay, that is also accepted. But on the PAT only, dividend is what? Declared. Why they levy one more tax? Question arises now. Any issue? See, shareholders income, again I say, PAT and shareholders income, correct? They pay the tax or not. Company and shareholder, yeah, lift the corporate will, correct? Yeah, my money only is company's money. Yeah, correct? Company is not jumping from heaven. Yeah, I only created it. Are you following? Simple question. See, I start a business and See, I'm starting a sole proprietor business. Yeah, I put money into the business, earn profit, I pay tax. I make drawings. On drawings, will they charge tax? Dividends also as good as what? Drawings. Yeah, my company has earned profit. It is giving me the profit back. Yes or no? For distributing profit, why tax? Question arises now. The question brings up now. See, because what the nation feels is that GDP should grow. Always GDP should grow. GDP grows, gross domestic product grows, only when there is new investment. If I consume money, it will not grow. Yeah, okay. I declare dividend and people start importing Samsung mobile from what? Korea and outside, say India. Okay, what happens is I am consuming. It is not necessary that the consumption should trigger any investment here. Are you following what I am saying? In that case, if I declare as dividend, then it need not become investment in the country. Yes or no? But if the company retains money, it will invest. Are you following? Always retention propels what? Growth. Growth in company is the growth of GDP. Right or not? When a company starts, suppose MT earns profit, keeps on distributing dividends. Yeah, Mahesh Shetty sir, he takes what? All the dividend and buys Benz and all the car. Yeah, okay. In that case, is there any growth in nation? But if you force him to what? Retain the money in the business, then it has to be say used for what? Opening new branches. At least education sector grows. Yeah, correct. Same thing happens for IT sector. Same will happen for what? All the sectors. Yeah. So to discourage dividend, to encourage what? Retention. G is equal to what? BR. Gordon's approach. Yeah, it is what? Gordon's approach. To discourage what? Dividend. To encourage what? Retention. They put a penalty on what? Dividend. That is called a CDT. Are you following not? The CDT is in what? Nation's interest that you should not consume money. One should what? Invest money back to promote the investment and to discourage what? Consumption. The CDT is levied. Are you following not? That is why in this case also when the company always tries to find out what? Possible investment opportunity. If no investment opportunity available only, the dividend should be what? Declared. If there's an investment opportunity, a dividend, now we cannot apply MM here. Okay, let me declare dividend and then what? Raise the money back because here the CDT also what? Acts against the MM hypothesis. It's not one of the assumption MM is no taxation. No taxation, no flotation cost. There are so many assumptions made by Modigliani Miller approach. So in this case, retention is better than what? Dividend because retention, no CDT. You will be having what? A corporate dividend tax to be paid. Are you following up? Now, come back to this particular sum. How much money is available? 1 lakh. What is put into the project? 80,000. Why did not put the remaining 20,000? I could not find any project that satisfies my requirement. Are you following not? In that case, I will declare the 20,000 as dividend after paying the corporate dividend tax. Can I proceed further? No. Okay. So residual dividend policy. What is the profit? 1 lakh. And what is the investment in A? 80,000. I don't say dividend. I say available for distribution. How much rupees here? 20,000. This distribution need not go to the shareholder. Some of it is distributed to what? Government as a tax and balance to the shareholder. Can I proceed or not? No. See. This calculation has been done at a different rate. Okay, I'll change it and then do the calculation now. Tell me how much is available for distribution? 20,000. Available, how much rupees? 20,000. In this, there's going to be CDT. There's going to be what? Dividend. Innapa right or not? No. Don't beat here. Can I see it now? In that, see, if there is a dividend of 100 rupees, dividend how much rupees here? 100 rupees. The CDT will be 16.995%. Including surcharge, etc. How much going to be? 16.995. If I total, what should be available for distribution? 116.995. Innapa right or not? No. This 20,000 is 100, 16.995, yeah, 116.995, 116.995. If 20,000 is 116.995, what should be 16.995? Calculator. 20,000 into 16.995 divided by what? 116.995. Tell me what is the CDT amount here? 1%? 2,905. How I got this number? 20,000 into 16.995 divided by 116.995 is the amount that is calculated, yes or no? That means what should be the balance dividend here? 20,000 minus 2905, or the dividend? 1%? 17,095 rupees should be given as what? Dividend. So I should declare 17,095 rupees as dividend. Pay on the dividend how much tax? 16.995% tax, 2905. So this is how the 20,000 surplus can be used by the company for the distribution to the shareholders. Everybody, are you all comfortable or not? With this, we have completed this particular problem on residual dividend policy. Now, here a small mistake, not mistake. Previous batch, I did not correct it. It is 17,323 because the surcharge has been increased. Okay, and the 15.45% tax is an old calculation. We'll do it once again. Can I proceed or not? Now, with this, the problem has been completed. Now, see, this sum is a good sum because it captures the full essence of what? Residual dividend policy. What notes we dictated for residual dividend policy? 2 points. Company should always maintain what? Constant capital structure. We have seen here, because even though there are projects like C and D, we is having more return than the cost of debt, I am not tempted to what? Use debt for financing and do those projects. I am disciplined. I am maintaining what? The constant capital structure has been proved here. Yes or no? Second is, always I should try to use what? Retention earnings first, because retained earnings is cheaper than what? Equity. Retention is only 20% cost and equity is how much? 23%. A project may be acceptable through retained earnings, but the same project can be rejected through what? New issue. Example is project B. Yes or no? In that case, sometimes the retained earnings may not be so much sufficient to finance a project. In that case, new issue also should what? Supplement. Supplementing using new issue may be making the project unviable. When it becomes unviable, then the retention should be distributed as what? Dividend is what this problem clearly captures. When a person looks at this sum, he will not know that he has to do all these calculations. Are you following? You know, they gave you 4 projects, retained earnings, debt equity ratio. Simply they ask what? What should be the dividend? And we should know the WACC should be recalculated for project B and then discuss about the dividend. A classic example for a residual dividend policy model, one of the ICAA final examination question. Everybody following on? Now, please copy the solution now. Write down step 1, WACC. I want you to copy fast. Please write step number 1, WACC. Sit and ask, yeah? No problem.
Why the company cannot invest in, full retained earnings in B and then go for A?
It is like cheating yourself, yeah, should I? Somehow I want to include Ganguly in the team, na? You make him captain, yes or no? No, correct. For example, yeah, okay. I just made an example, okay. Okay, somebody, okay, like that. B should get the project on its own merit. Should get the project on its what? Own merit. You should not place ahead of A in giving the retained earnings. That's what I am saying. I will preview after the class that your earnings will be less than what you have by doing only A. I will prove it later. Yeah, it is very bad because I want to somehow make second rank project what? Then I can say, why can't I allocate debt and all fully to what? C and even C can be taken. Yeah, let me allocate fully to what? Debt to C. A can withstand equity. Let me put what? Equity for A. Na? That is cheating yourself. Yes or no? You have to somehow accept the project. So do all the adjustments. That is not the way. It should be selected based on its own merit and should not be based on what? The merit of another project. I will prove through numbers later. Yes, A is having the highest IRR, na? That is why I should give it to A. Now, again I say, B I am not rejecting because A has taken retained earnings. Because the money has got a better use. The money has got what? A better use. Because the shareholder expects some return or not. 23% return is expecting a 20% better use. Hence I am not given to B. I give it back to shareholder. So not. Now it is between B and shareholder, not B and A. Are you following? A is selected first. Always A should be selected what? First. And B should be selected if on its own merit, after meeting capital structure, it is able to satisfy. Capital structure should be satisfied for each and every project independently, and that too they should give returns to the first rank project first and then go for the second rank project and so on. Later, not in the class, I'll tell you through numbers how if we give it to B, the probability much more lesser than what you do now. Understood?
Then if the requirement is more, for example, if you have to borrow again for A, if we don't have enough funds, then in what proportion will be share the retain?
Same 0.4 is 1. Very simple. Yeah, suppose A requires 2 lakh rupees. What happens? I have only what? 1 lakh? 40,000. 60,000 should be in ratio of what? The borrowings and new equity. Then this is not the WACC for A. Recalculate what? The WACC for A. Understood? Abba? It should be selected based on his what? Own merit, and don't mix two projects for the selection. Okay. More discussion after the class here, because everywhere this gets discussed, the class gets what? Dragged. Don't worry. What we done is what? Perfectly right. Can I proceed now? And believe me, if you don't believe me, come after the class, please. Really. Now finish copying, huh? Whatever. Sorry. Finished now? Last line. But for doing B, from there, A and B has IRR more than WACC. I'll declare that box. A and B has IRR more than WACC, weighted average cost of capital. Hence qualifies for selection. Hence qualifies for selection. But for doing B, additional amount also needs to be raised. But for doing B, additional amount also needs to be raised through equity issue. But for doing B, additional amount also needs to be raised through equity issue. Also needs to be raised through equity issue. Respond. Can I proceed or not? No. Right on. Step 2. Step 2. Analyzing the financing pattern of A and B. Step 2. Analyzing the financing pattern of A and B. Analyzing the financing pattern of A and B. At fund required 1,68,000. Fund required 1,68,000. A, B. Branch into two. A, B. How much A requires? 1,12,000. B requires 56,000. A 1,12,000. B 56,000. For both, right, bracket 0.4:1. What is 0.4:1? Capital structure, debt equity ratio 0.4:1, 0.4:1. A 1 lakh 12 branched into 2, debt equity. A 1 lakh 12 branched into 2, debt equity. 32,000 debt, 32,000 debt and 80,000 equity. 32,000 debt and 80,000 equity. This equity can come from two sources, retention and new issue. What is going to be used first? Retention. Put a down, I can write retained earnings. This equity is through retained earnings. B 56,000 branched into 2, debt equity. B 56,000 branched into 2, debt equity. 16,000 40,000. Debt equity 16,000 40,000. 40,000 equity should be further classified as retained earnings equity. Retained earnings equity. Out of 1 lakh 80,000 used for A now, what is balance available? B 20,000, and for equity it is going to be 20,000. A 20 and equity issue is 20,000. Equity issue is 20,000. Now, are you understanding writing or not? Tell me how I am going to finance 46,000 of B. Through borrowings 60,000, to new issue 20,000, to plowing back existing profit 20,000. Everybody following or not? Now, let's put the next slide. Calculating WACC of B. Finish copying, huh? Finish copying, huh? The last line you can write on your own here. Project B cannot be accepted as IRR less than WACC. தூங்கிண்டே எழுதாத, don't sleep and write. Apply your mind. Last line can be understood. Okay. Project B cannot be accepted as its IRR less than WACC. Project B cannot be accepted as its IRR is less than WACC. As IRR is less than weighted average cost of capital. Over, huh? Write down. Next. Step 2 or step 3 or step 4, huh? Right, step 4. Step 4. Distribution to shareholders. Step 4. Distribution to shareholders. Distribution to shareholders. Okay. Can I proceed now? No. Profit 1 lakh. Do along with me. Profit 1 lakh. What residual policy says here? After meeting a investment need, anything balance, give it to what? Shareholders. Minus investment in A. A part of the profit is given to the say in A project, so minus investment in A. How much rupees? 80,000. Balance is available for distribution. Available for distribution. How much is available for the distribution, dividend distribution? 20,000. Available for dividend distribution, 20,000. Can distribute the entire 20,000 shareholder? No. You know, have to pay what? CDT. Write down. Next, right? I'll dictate CDT. Write down CDT is equal to, what is the calculation? 20,000 into CDT is equal to 20,000 into what? 16.995 divided by 116.995. 20,000 into 16.995 divided by 116.995. What did you say? CDT 2905. CDT is 2905. Corporate dividend tax 2905. Next, dividend distributed. Dividend distributed 17,095. 17,095. Dividend distributed 17,095. 17,095. Okay. With this, we have completed this particular problem on what? Residual dividend policy. Two problems we learned in the residual dividend policy. Okay. Now, ultimately, every model or every concept, we learn something new about it. Yes or no? Walter says declared dividend R is greater than KE. Gordon says don't declare too much dividend or too much retention because risk angle is involved. Says declaring dividend or retention is same, and so on. What we learn from resident dividend policy? Two things. Number one is always company should maintain a constant capital structure. They should not alter the capital structure in temptation of accepting some new projects. Are you following not? Second thing is, when they have to contribute towards the equity, first option should be what? Retention, and then only should be going for issue. We cannot accept proportion saying that both are equally good because the new issue has got what? More cost due to its obvious reasons. Are you following not? This is what has been learned in this particular residual dividend policy. Can I move to the next problem or not? No. Shh. Don't. Okay. One more point I will discuss before I go for the next issue. Okay. It is a common point for all the models. See, I am having 20,000 now. Forget about CDT and all. It is country specific. Okay. Normally, I am having 20,000 money now. When I return back the money to shareholder, is the company investing or not investing? It is investing at 20% KE. Did you follow or not? Listen here, please. This I am going to discuss in the next sum elaborately. Hence, I am putting a seed to it now itself. Okay, listen here. Company has earned profit. Suppose earned how much profit? 1 lakh profit. 80,000 profits only can find investment. 20,000 surplus cash. 20,000 is what? Surplus cash. Can a company keep surplus cash? Tell me. Why you say no? Let me keep the cash. I have pocket, I'll keep the cash. What is wrong in that? I have bank account. Can a company keep surplus cash? I'll say what happens. If a company keeps surplus cash, it happens in company like Apple and all, where they have what? So much cash, they keep in their current account. Yes or no? It will be earning them 2% interest. Yeah, correct. Some country no interest also. In that case, they'll be earning 2% return on that. Yes or no? But the shareholders are wanting, for example, 14% KE. What is the KE here? 14%. Your 14% generating money, you are investing for what? 2%. Your cost of capital is 14%. The IRR is what? 2%. NP will become negative. The money value will reduce. Today it is 20,000 here, but when the shareholder, everybody knows that when invest back at what? 2% they say, the NPV for this will be what? Negative. The 20,000 will be reduced by what? Negative NPV, and the money is what? Less than 20,000. Are you following? Should I repeat? Should I repeat? Those who want to repeat, raise your hand. Okay, I'll repeat once again. See, I said always wealth is the current money plus new NPV. Correct? See, 20,000 rupees I have in my hand now. I have in my hand what? 20,000. Present value of cash is what? 20,000 only. I say cash present value is 20,000 because it is capable of generating return the cash holder wants. If I give it back to the shareholder, you can get 14% return on it. That is why he wants what? 14%. So the present value of 1 rupee is what? 1 rupee, provided that you are able to earn the required return on that 1 rupee. Yes or no? Suppose you are 20,000, it is your money now, I keep it, yeah. I invest in a current account. Invest in what? Current account. It gives me 2% interest. How much you want? And how much I get? 2%. In that case, imagine like this. Today, I invested 20,000. Okay. Year 0, I have surplus cash now. I put into SB account. How much is here? 20,000. Okay. Say I invested for example 1 year. How many years here? 1 year. It gives me 2% interest. How much percent interest here? 2% interest. This 20,000 will be 20,000. More than 20,000. More than 20,000. Tell me what is the number here? 20,400. 20,400. Now this is like a project. It's like what? Project. Where year 0, 20,000 invested, and year how much you got? 20,400. I should find out NPV for the project or not? To calculate NPV, I should discount at what rate? Cost of capital. What is your cost of capital? 14%. Yes or no? When discount at 14%, what happens is, please tell me, here, cash flow, present value factor, how much percent? 14%, discounted cash flow. All of you tell me the number. Year 1, how much I get? 20,400. 1 divided by 1.14, I want a number. What's the number? 0.8772. And what is the amount? 17,890, some number, 17,890. The discount inflow, no. Tell me, NPV is equal to discounted inflow minus what? Discount outflow. What invested here? 20,000. 17,895 minus what? 20,000. Can tell me the NPV amount? Minus 2105. In other words, today the cash in hand is 20,000. As soon as the public comes to know that you don't have any use for it, they know that you're going to invest at 2%. Now, this cash becomes an FD. This cash becomes what? FD. The value of the FD is not 20. The value of FD becomes what? Immediately 17,895 because that FD gives you only 2% IRR, but you want how much? 14%. We saw in modular approach, no. Now 10,000 cash becomes an investment. The entry is what? Investment to cash. Kadaba. The entry is, I have 20,000 cash. I am going to make the surplus cash as what? FD. Tell me what is the entry? Investment account debit to what? Cash. The cash, how much will be credited? 20,000. But investment account will debit 20,000. In accounts you put 20,000. In my balance I put only what? 17,895 because the 20,000 cash is what? Only how much? 17,895 investment because my cost of capital is 14 and IR is only what? 20 is a 2%, having a negative NPV. Yes or no? Immediately when the market comes to know that the company is sitting on an idle cash, they don't say so much cash company is having good. Yeah, it's a bad company because it does not know what to do. Your investment they're keeping it idle. Yes or no? In that case, what am I? Immediately what? The share price drops. Are you following what I'm saying? Tell me, sitting on a cash is good or bad? It is always what? Bad. If you don't know how to use the money, give it back. Yeah, because if you keep it in SB account, I'm keeping your money without earning anything for it. Yes or no? And they show it through what? Negative NPV. Immediately the 20,000 cash will not be shown as cash 20,000, be shown as what? FD 17,895. The balance sheet value drops. Are you following? That means if I cannot find any other investment, when I return back the money to you, what happens is I save a cost of capital of 14% or not. Your money I'm keeping. As long as I keep your money, I have burden of earning for you 14%. If I keep a debenture holder's money, I have burden of earning for him 10% interest. If I keep a preference shareholder's money, I have burden of earning what? Preference coupon for him. Right? Not like that. If I keep a shareholder's money, I have a burden of earning for him KE. So no, I say, take your money out, I throw it to you back. What happens here? My burden gone here, I invested back the money to you at 14%. So no, because repayment of money is saving what? Cost of capital. I need not earn only through earnings and even earn through what? Savings. So giving dividend or returning money is as good as what? Reinvestment. I reinvest back at KE. Are you following what I'm saying? Adam Walter says, if you are able to invest back more than KE or not, then you invest. Otherwise what? Give it back. In the net means what happens here? The company is what? Giving the cash back and thereby saving what? A cost of equity. Saved cost is earned interest. In that case, I am having a reinvestment at the KE. So any dividend declared, don't think that the company is not investing. It is investing back the money to the shareholder and saving how much cost? Cost of equity. If you don't understand still, last example. Suppose, forget about equity shareholders. I have borrowed money at 10%. How much percentage here? 10%. Now, I have to pay interest 10% or not? I earn some profits. In that, I can repay my borrowing. When I repay the borrowing, I am investing. Yes, I am investing because by repaying borrowing, from today onwards, I stop paying 10% interest. Yes or no? So by repaying borrowing, I am avoiding a cost of debt or not? So a repayment of borrowing is a reinvestment at cost of debt. I have two options. I am having 1 lakh rupees. I can repay borrowing, saving 10% interest. Or I invest in project A, which gives me 12% IRR. Tell me, will I save 10% interest or earn 12% IRR? I earn what? 12% IRR. In that case, I will not invest by repaying borrowing. I invest by what? Investing in a project. Are you following what I am saying? See, any money I get, when I get the money, I should not look and sit at it. I should not want to sit at it. I should act on the money in my hand. Yes or no? How I can act? Either I can use the money for new projects if it gives return more than what the money provider gives me. Yes or no? Or I should at least want return the money back and save my cost of capital. If I do nothing, neither invest nor return. I'll pay cost of capital. I don't invest. The NPV what? Reduces. Share price is pulled down. Are you following what I am saying? That is why I said sitting on cash is what? Bad. Always bad. Sitting on cash is not reinvesting money. Companies always reinvest what? Money. If it has a project, reinvest it in what? Project. No project means what? Reinvest by giving it as what? Dividend or repaying loan, etc. etc. Everybody following or not? In the angle, this nobody disputes. From Walter till MM, everybody what agrees with that money should not be kept idle. Money should be distributed immediately. We don't have any other use for it. Everybody are following or not? Now, keep this in mind before I start with the next problem. Everybody, can I proceed or not? I'll give this as a notes at the end of the next sum. It's an institute RTP problem. It's a case study type of sum in this dividend policy. It is a very good sum, very simple to calculate, that captures most of the issues in the dividend policy discussed till now. Okay, now take the next problem. Shall I proceed now? Please, stop talking. Take question number 10. CMC, please. Shh. Till now not asked in the examination, could be anytime asked. 2 RTPs, the problem has been repeated. Okay. Included because it gives me a platform to discuss more about the share valuation. Problem gives me a lot of scope for discussion and the problem has been included. Not only numbers we're going to calculate, we're going to interpret as much as possible. Walter, Gordon, everything will come into the picture while doing this particular sum. Can I start or not? No. CMC PLC has an all common equity capital structure. If it has, it is not if, it has 2 lakh shares of £2 par value equity shares outstanding. When CMC's co-founder was also its research director, and most successful inventor, retired unexpectedly to the South Pacific in late 2005. CMC was left suddenly and permanently with materially lower growth expectations and relatively few attractive new investment opportunities. Unfortunately, there was no way to replace the founder's contribution to the firm. Previously, CMC found it necessary to plow back most of its earnings to finance growth, which averaged 12% per year. Future growth at, make a small change, typing mistake, 6%. Okay. Future growth at 6%. Please make the change as 5, make it as what? 6. Printing mistake. Future growth at 6% rate is considered realistic. But that level would call for an increase in the dividend payout. Further, it now appears that the new investment project with at least 14% rate of return required by CMC shareholders, KE is equal to 14%, would amount to only 8 lakhs for 2006 in comparison to projected 20 lakhs of net income. If the existing 20% dividend payout were continued, retained earnings would be 16 lakhs in 2006, but as noted, investment that yield the 14% cost of capital would amount to only 8 lakh pounds. The one encouraging thing is the high earnings on the existing assets are expected to continue, and net income of pound sterling 20 lakhs is still expected for 2006. Given the dramatically changed circumstances, CMC's board is reviewing the firm's dividend policy. Assume that the acceptable 2006 investment projects would be financed entirely by earnings retained during the year. Calculate the DPS in 2006, assuming that CMC uses the residual payment policy. What payout ratio does your answer to part A imply in 2006? If a 60% payout ratio is adopted and maintained for the foreseeable future, what is your estimate of the present market price of the equity share? How does this compare with the market price that should have prevailed under the assumptions existing just before the news about the founder's retirement? If the two values of P0 are different, comment why. What would happen to the price of the share if the old 20% payout were continued? Assuming that if this payout is maintained, the average rate of return on the retained earnings will fall to 7.5% and the new growth rate will be G is equal to 1 minus payout ratio into ROE, 1 minus 0.2 into 7.5% is equal to 0.8 into 7.5 is equal to 6%. This is the question. Don't clap here. I will give you a few minutes time. Now, make an attempt to read the question. What is that? I already read it. You should have been listening it. Once again, go through the question carefully so that solution becomes much more simpler. Go through the question quickly, please. Why so late, yeah? Slept, huh? I appreciate, yeah. He wants to see me daily. Correct? He comes and sees me. Yeah, Mukalik class only. Okay, now. Shall we start? Now, see. Let us summarize to some extent. More about the situation can be understood as we progress into the calculation. Calculations are very small calculation, nothing going to be big. Answer is also very small only. Interpretation only will be done as we progress with the solution. Okay, now please. This is a company having 2 lakh shares. How many shares here? 2 lakh shares. Please. 2 lakh shares. What happened is, the founder of the company is going to retire or has retired. Okay. And due to the founder's retirement, the main problem is he was instrumental in finding new opportunities or avenues for the company. After founder's retirement, it is felt that the company cannot find out new growth opportunities. The growth rate of the company, which was 12% during the founder's time, is expected to drop to how much percent? 6% is issue number 1. Okay. Due to the founder retirement, what the negative issue? The growth is going to reduce. The company cannot grow as fast as what it was doing when the founder was there, because he is a person with innovation. He will be able to find out new projects. But with the absence of founder, what happens is the number of projects available gradually reduces. The growth drops to 6%. This is point number 1. Understood or not? But the good thing is, what profits they are at present earning, they will continue to earn forever. Understood? That is, just because founder has retired, the existing clients will not switch over to another company. They are going to be committed to what? The company itself. In that case, the current earnings is not going to get affected. What are the current earnings of the company per annum? 20 lakhs. The 20 lakhs continues. Are you following or not? Now, with founder, every year when they earn 20 lakhs, they can find investment opportunities for 16 lakhs. How much is here? 16 lakhs. That means they have been following a payout policy of 20% and retention of what? 80% using residual dividend model. Are you following up? Because they are able to identify investment opportunities. So how many lakhs? 16 lakhs. And 4 lakhs only declared as what? Dividend. 4 out of 20 lakhs, 20% given as dividend and 80% given as what? Retention during the founder's time. Are you following up? But now after founder's retirement, they are not able to find out investment project worth 16 lakhs. They are able to find only project worth how much rupees? 8 lakh rupees. That means naturally they should be retaining how much lakhs? 8 lakhs and distributing what? 12 lakhs as dividend. Their payout should now change to how much? 60% from what? 20% and retention to become how much percent? 40%. Up to this, are you following? And the expectation of the investor is how much percentage? 14%. That means only projects which give more than what? 14% can be accepted. Others will be what? Rejected as per residual dividend policy model. That's why the problem also says project giving more than 14% was 16 lakh rupees project when founder was there. That's only what? 8 lakh product when the founder is not there. Are all the details given in the question, nothing more. In a question details are put in the okay, now with founder, without founder. Tell me, with founder, what is the growth rate? Numbers should be in mind. You should not be grappling for numbers now. With founder, what is the growth rate? 12%. Without founder? With founder, what is the profit? Without founder? It is expected to continue. With founder, I can find out investment opportunities giving more than 14%. What is 14%? KE. How much lakhs here? 16 lakhs. Without founder? 8 lakhs. With founder, the payout was how much percent? Retention is 80%. Without founder, still we are not yet decided, but as per residual policy, the payout should be how much percent? 60%. Retention should be 40%. These are all the details given. Are you following or not? And the company says how many shares here? 2 lakh shares. This is the summary of the question. Can you proceed further or not? Now, The questions are very, very simple and easy. It is not difficult to answer this in the exam. Can you start answering the question one by one or not? Now, let's take one by one. Part A question. Please read. What is Part A question? Assuming that acceptable 2006 investment projects would be financed entirely by earnings retained during the year, calculate the dividend per share for 2006, assuming CMC uses a residual payment policy. Can you start or not? Write down first. We'll do it together. No slide. Calculations are 1 or 2 lines maximum. Okay, write down Part A. Part A. DPS. DPS means what? Dividend per share. Using residual payment policy. Part A. DPS using residual payment policy. That's a question, no? DPS using residual payment policy. Dividend per share using residual payment policy. Underline that. That right first. Profit is equal to how much a base? 20 lakhs. Profit is equal to 20 lakhs minus retain for investment. Now founder has retired. Do I require 16 lakhs or 8 lakhs or 8 lakhs? Minus retain for investment. Write the amount as 8 lakhs. Minus retain for investment 8 lakhs. What is the balance here? Dividend. Dividend is equal to 12 lakhs. Dividend is equal to 12 lakhs. Dividend is equal to 12 lakhs. DPS, dividend per share is equal to 12 lakhs divided is how many shares here? 2 lakh shares. 12 lakhs divided by 2 lakhs. 12 lakhs divided by 2 lakhs is equal to how much rupees per share? 6 rupees per share or 6 pounds per share. The question is given in what? Pounds. Yes, pound 6 per share. The dividend per share is pound 6 per share. Up to this, I have the clarity or not? No. I am just going through the question. Wherever elaboration required, I'll just do it. Just follow the question as it is in the flow. Can I proceed? Now, first question is answered. What is dividend per share? 6 pound per share is the dividend per share. Can I proceed or not? Next, Part B. What payout ratio does your answer to Part A imply? Write down. Next, Part B. Part B, payout ratio. Part B, payout ratio. Payout ratio. Underline that. EPS is equal to 20 lakhs divided by 2 lakhs. And 20 lakhs profit should be shared by 2 lakhs or not? EPS is equal to 20 lakhs divided by 2 lakhs. What is EPS? 10. EPS is equal to 10. DPS is equal to, already calculated na, dividend per share. Dividend per share is equal to how much? 6. EPS is equal to 10. DPS is equal to 6. Payout ratio is equal to, we all know what is payout ratio? DPS by EPS. Payout ratio is equal to DPS by EPS. Is equal to 6 divided by 10. 6 divided by 10. What is the payout ratio? 60%. Out of 10 rupees profit, I give you how much of dividend? 6 rupees. I pay out 6 out of 10. 60%. Therefore, you can also write one more line. Therefore, retention ratio is equal to, how much percentage here? 40%. Therefore, retention ratio is equal to 40%. That is G is equal to, that is B is equal to, in Gordon, B means retention, na? B is equal to how much? 40%. B is equal to 40%. B means retention, 1 minus B means what? Payout. B is equal to 40%. Gordon terminology used. Can I proceed or not? No. Part A question answer, Part B question answer, both are simple questions. Right or not? No. Next, Part C. The question is, based on this dividend policy, what you are doing, they ask you what is the share price. What is the share price? Had the founder not retired, what would have been the share price? Anybody saw? No. Now, I can say 2 things here. In the newspaper, founder retirement announced. In the newspaper, founder retirement not announced. Then the share price will be different or not? Always share price reacts to information already said, and nothing but the information about the company only is called as what? Share price. So let's see what will be the share price when the founder retirement is known. All this data are known to shareholders. Nah? What will be the share price? If this data are unknown, what will be the share price? You have to find out share price before the founder retirement, after the founder retirement. Respond yes or no? No. Write down part B or part C? Part C. Part C. Market price of the share, give the heading, market price of the share, MPS, market price of the share, before and after founder's retirement. Market price of the share, before and after founder's retirement. Market price of the share, before and after founder's retirement. But can I proceed above? No, underline that. He use a Gordon's formula. P0 is equal to what? E into 1 minus B divided by KE minus BR. E into 1 minus B divided by KE minus BR. Can I simplify it? E into 1 minus B is dividend. Dividend divided by KE minus what is BR? Growth rate. So can we accept this as a share valuation formula? Dividend divided by KE minus G. You have to look at the problem, use the appropriate formula, growth rate and all given or not. So you have to naturally use this particular formula. So P0 is equal to D by KE minus G. Are you all writing along with me or not? Can I proceed? Now, first let us calculate the share price before founder retirement. Here is the share price before founder retirement. Okay. Tell me, before founder's retirement, I am going to pay how much percentage as dividend? Because I am going to retain what? 80%. I want to declare how much percent dividend? 20%. Discuss at the beginning of the problem itself. Yes or no? So I am going to declare how much percent dividend? 20% of the earnings as what? Dividend. I can say dividend is equal to earnings is what? 10. E is what? 10 into 1 minus what is retention here? 0.8. I am going to retain 80% of the money and give only 20% as what? Dividend. Dividend is equal to 10 into 1 minus 0.8. Tell me what is the dividend here? 2 pounds will be the dividend. 2 pounds will be the dividend. I think you're all following or not? So when the founder was there, the shareholder will get only how much dividend? 2 pounds as dividend. Respond yes or no. When the shareholder was there, the growth rate is how much percentage here? 12%. When the shareholder was there, the growth rate is 12%. And the KE already known, always the investor expect how much percent return from the company? 14%. The KE is how much percent? 14%. We all know the formula. P0 is equal to what is D2 divided by pound sterling 2 divided by 2 divided by what minus what? 14% minus 12%. 2 divided by 14% minus 12%. I want you to answer me how many pounds here it is going to be pound sterling? 100. Now the share would have been trading at 100 pounds had the news about pounds, the founder retirement has not come to the public. Respond yes or no. So what is the share price here? 100 pounds. Please tell me yes or no. Now after founder's retirement. After founder's retirement. Okay. Now, we know D already calculated. What is D here? Pound sterling 6. We calculated DPS in the first part. After retirement, what is the dividend here? Pound sterling 6. Dividend is pound sterling 6. Growth rate will be 12%. Less than 12%. How much percentage is going to be? 6%. Growth rate is 6%. KE is going to be how much percentage here? 14%. K is 14%. P0 is equal to 6 divided by 14% minus 6%. 6 divided by 14% minus how much going to be pound sterling? 75. The share price become pound sterling 75. So the part C question partially answered. What is that the first question here? What is the share price before the retirement? After the retirement. Before the founder's retirement, the share would have been trading at how much pounds? 100 pounds. But when the news about retirement comes, what happened? The share price crashed. How many pounds here? 75 pounds. It happened in many companies or not. So Steve Jobs died. The Apple price crashed. Maybe reviving later due to performance. Same thing happened for what? Earlier, Narayan Murthy also. So whenever a key member of a team or board is going to retire, their contribution is going to be what? Lacking or absent. With the share price what? Crash. From 100 to what? 75. Respond. Point number 1. Are you following or not? Now, let us see into the number deep what has happened. Let's see what has happened. It helps us in further interpretation. Can I see? Now, why the share price has dropped due to founder retirement? Question arises now. We know the founder, great person, he retired, so share price what? Drop. There's one way of understanding. You have to go deeply to know why the share price has dropped from 100 to 75 due to founder's retirement. That's question. The question is, if the two values of P0 are different, you see the question or not? If they are different, comment on why. Now, can I proceed or not? No. See. No need to write. I'll discuss and give you the notes. Okay. There are some hidden numbers into this particular problem. Okay. First of all, G is equal to B into R. G is equal to what? B into R. Growth rate depends on how much you retain on what return you earn on the new investment. Now, we know that with founder, the growth rate is 12%, 0.12. And they are retaining how much with founder? 0.80 into R. If I calculate R, R is equal to what by what? 0.12 divided by what? 0.80. Tell me what is R? 0.15. How much percent? 15%. Understand that. Shareholders wanted how much return? 14%. But they are able to identify investment, how much percent? 15%. So with founder, they are able to find out positive NPV investments. What investments here? Positive NPV investment. What, 16 lakhs every year? Yes or no? Yeah, correct, huh? If the investment R is 12%, they won't retain. They'll give us what? Dividend, because when R is less than KE, they will declare dividend. Yes or no? That means company is able to scout for the project. They're able to what? Identify a project which gives how much percent return? 15%. That is, the return required is only what? 40. They're able to create a 1% margin. They're able to create what? 15% return projects every year. What? How much lakhs? They are 16 lakhs. They're able to retain 80% of the money and create a NPV for the 18% of the money. So no. I can say like this. They are investing 20% of the money in 14% and 80% in 15%. Correct. By declaring dividend, they are investing at what? KE, 14%. By returns, they are investing at what? 15%. In that case, founder is able to invest more at 15% and less at 14%. That is why the growth is happening. Correct. Did you follow? The discussion now, don't start saying something, return the numbers, leave it. Don't think like that. Dividend policy will be discussed only this way, how to understand the content. Now, again I say, very simple. I am the founder. Accept it? Yes, sir. I am the founder. Okay, for example, when you retire, give you farewell. Can I say it? Till then, no treat. Can I say it? Now, see, I am the founder. With my presence in the company earn 20 lakhs and not. Every year, company has 20 lakhs in hand here. It should do something with that. I'll simply say, with founder, it retains 16 lakhs and distributes 4 lakhs. That means 4 lakhs money, when it distributes to shareholder, it is investing at 14%. Now only I said earlier at the beginning of the problem that distributing to the fund provider is as good as reinvestment, where I save a cost of capital. Are you following what I'm saying? So, when I have a 12% project, suppose I have what? 12% project for 4 lakh rupees, I invest in 12% project. No. Rather than getting the money at 14% and paying 12%, what I will do? I will ignore the project, give the money back so that I can save 14% cost of capital. Yes or no? Returning the money itself is what? Investment only. With founder, the company is investing 4 lakh rupees at what percent? 14%. And another 12 lakh rupees at what? 15%, which I found out here. Yes or no? For 12 lakh rupees, I can find out investments more than what? Cost of capital, which can generate a positive NPV. And for another how much rupees? 4 lakh rupees. I can only satisfy my, say, the fund providers by returning the money back, by investing back at 14%. Are you following? This is a founder situation. But without founder, what happens is, in the 20 lakhs, the 15% return generating investment has become only what? 8 lakhs. And the balance 12 lakhs, I'm giving back to what? Shareholder. That means the company is investing back at what? 14%. That means it is earning more return, less return. The share price has to be less. The growth rate is going to get what? Stagnated. In other words, if you see the growth rate after the founder's retirement, very simple. Growth rate is equal to, what is retention? 0.6. Correct? 0.4? The retention is 0.4. 60% dividend, DPS 6 rupees. What retention? 0.4. On that, I earn how much here? 15%. I can find out 15% project only for what? 40% of my money. So what is the growth rate here? 6%. That is why they say the growth has crashed from 12% to what? 6% when the founder was not there. Are you following what I am saying? No. So now, when the founder was there, the advantage is growth is 12%. When the founder was not there, the disadvantage is what? The growth has become 6%. That is why the share price is higher. First point. Yes or no? You may jump and say, sir, what happened to Gordon? Because Gordon says, when the founder was there, the company is retaining more. Yes or no? When the founder is not there, it is declaring more dividend. Yes or no? In that case, more retention, more risk. The K should have been higher. How can you use the same 14% discount rate for this valuation as well as what? This valuation, because when you retain more the retention, more the risk. Then the K should have what? Increase. The public should be having more fear. Right or not? Not so, because the public has got the same confidence with the founder retaining 80% and the non-founder retaining what? 40%, because their confidence level in founder is much more higher. Yes or no? Is the contribution of founder to the company. He creates investment opportunity, also creates trust. Any person generates value to the company in two ways. Financially, also through what? Trust creation. Are you following what I am saying? Very simple. 14%, the public says, I want 14% for the company when the founder was retaining 80%. And when the founder was not there, when they are distributing what? 60% dividend and retaining just half, then also they require what? 14%. Because they feel that founder retaining 80% and without founder retaining what? 40%. Both are equally risky because they have such a confidence in the founder. Are you following what I am saying? And Gordon cannot apply here because retention alone is important. Who is retaining is important. Yes or no? Now with founder, I feel my money is safe with the company, hence I feel the same risk. Without founder, if the without founder retain 80%, what happens here? In the case, probably KE may also want to increase, may or may not, I don't know. Probably KE may want to increase. The KE does not change. The justification I'm giving is with founder, retention more will not create more risk. It is having what? The same risk only. So the risk remains same. The growth has what? Increase. The share prices increase. Are you following or not? Now, in such case, tell me, what is the value of the founder here? Question arises, no. Today, what is the value of the founder? Founder is able to create 25 rupees value for the share. Without him, the share is worth how much? 75. With him, the share is worth how much? 25. I can say the founder's value for the share is how much? 25. So how many shares here? 2 lakh shares. He will be given 50 lakh settlement. Are you following what I mean? Because he is worth how much? 50 lakhs for the company. He creates for his shareholders a wealth how much rupees? 50 lakhs. That's the value of the founder to the company. The market cap due to the founder is how much? 50 lakh rupees. Is the value of the founder to the company. Everybody following not? In this world, anything can be valued, but one should know the sense of what valuation. Everything becomes easily and understandable, interpretable. Are you following not? With this, we complete the next part of the question. Now, so to conclude, now we have answered part A. Don't get too much confused. We have to understand what has been discussed now. Part A question, we calculated what? Dividend per share without founder. What dividend per share without founder? 6 rupees. Correct? 6 pounds. It is due to what? The residual dividend payment policy. And number 2, we calculated number 2 what? Payout ratio. What the payout ratio without founder? 60%. What the retention ratio? 40%. We found the share price with founder, without founder. With founder the price is 100. It becomes what? 75. Why the price has crashed? Because with founder I am able to have a growth rate of 12%. Without it's going to be only how much? 6%. Why it is so? Because with a growth rate of 12% and a retention of what? 80%, it means that I am earning how much return? 15% return on my investment. With founder, 20 lakhs profit, 16 lakhs is invested at 15% and balance 4 lakhs returned back at what? 14%. But without founder, 12 lakhs is returned back with what? 14%. 8 lakhs only invested for what? 15%. Obviously, the NPV is going to reduce. Hence, the share price has dropped with the founder's retirement. Question is, sir, more the company retains with the founder or not? So wouldn't the Gordon policy apply? No, because the public has got the same confidence of 80% retention with founder, what we have 40% without founder. Is the answer for that particular part of the question also? Are you able to understand the interpretation or not? Now, you can have the notes up to this stage before you go for the last calculation. It's also very, very important. Write down notes. For this point C, we are writing the notes. Write down notes. My question is, have you calculated the, have you written the share price calculation? 70 by 100 finish writing or not? Write down notes. Point number 1. Point number 1. G is equal to B into R. G is equal to B into R. What is the growth rate with the founder? 12%. 0.12 is equal to 12% can be written as 0.12 or not? 0.12 is equal to 0.8 into B is 0.8 na? 0.8 into R. 0.12 is equal to 0.8 into R. R is equal to 0.12 by 0.8. R is equal to 0.12 by 0.8. Is equal to how much percent? 15%. Is equal to 15%. Is equal to 15%. Okay. Can I proceed? Point number 2. Point number 2. When founder was there, the company was able to find, when founder was there, the company was able to find projects giving 15% IRR. When founder was there, the company was able to find projects giving 15% IRR for about how many lakhs? 16 lakhs. For about 16 lakhs of its profit. For about 16 lakhs of its profit. So 16 lakhs of its profit, you can find out what? Investment giving 15% IRR. About 16 lakhs of its profit. And the balance 4 lakh profit, was distributed as dividend. And balance 4 lakhs profit was distributed as dividend. Balance 4 lakh profit was distributed as dividend, which can be understood as investment at, how much percent? 14%. Even if you repay something, you are saving a cost. Cost saved is what? Return earned. Okay. Investing at 14%. It can be understood as investment at 14%. Respond yes or no. Next. Point 2 or 3? 3. Without founder, the company could find only 8 lakhs pounds investments. Without founder, the company can find only 8 lakhs worth investments. the company can find only 8 lakhs worth investment giving. The company can find only 8 lakhs worth investment giving what return? 15% return. 8 lakhs worth investment giving 15% return. And the balance 12 lakhs are distributed. And balance 12 lakhs are distributed. That is, earn only. That is, they earn only. When I distribute, they earn cost of capital or not? That is, they earn only how much percent? 14%. That is, they earn only 14%. Hence, the growth has reduced. Hence, the growth has reduced from. Hence, the growth has reduced from what to what? 12% to 6%. Hence, the growth has reduced from 12% to 6%. Bracket la G is equal to, tell me how I got 6% here? 0.4 into 0.15. 0.4 in, that is 0.4 into 15%. Na? 0.4 into 15%. Is how much percent? 6%. 0.4 into 15% gives you 6%. G is equal to 6%. Can I proceed last point or not? 0.2, 3 or 4? 4. Without founder, retention was less. Without founder, retention was less. And with founder, it is more. Without founder, retention was less. And with founder, it is more. Without founder, retention was less. And with founder, it is more. Hence, as per Gordon, KE should have been higher. As per Gordon, KE should have been higher with a higher retention. KE should have been higher with a higher retention. Are you following or not? In a founder, growth is more, yeah, but K also be more or not. So K has been higher with a higher retention. That is, with founder, growth also should be higher. That is, with founder, growth also should be higher, and KE also should be higher. Growth also should be higher and KE also should be higher. But KE did not change. Why? But KE did not change. Why? You understand the question or not? Founder retained more, the growth is more. Everybody understood that. But the risk should also be what? More. So why? Write down. The market perceives founder retaining 80%. The market perceives, founder retaining 80%. The market perceives the founder retaining 80% and without founder retaining 40%. The market perceives founder retaining 80% and without founder retaining 40%. And without founder retaining 40% to have the same risk. The market perceives the founder retaining 80% and without founder retaining 40% to have what they perceive, to have what? Same risk. To have same risk. Hence, K did not change. Point C or D or E? Not point 5, no? Point number 5. Thus, the value of the founder to the company is, the value of the founder to the company is 25 pounds into, why I say 25 pounds? Without him shares was only 75, no? 25 pounds into 2 lakh shares. The value of the founded to the company is 25 pounds into 2 lakh shares is equal to how many pounds? 50 pounds. 50, that is 50 lakh pounds is equal to 50 lakh pounds is equal to 50 lakh pounds. Everybody, are you comfortable or not? Now, next. Last point, let us discuss part D. Suppose the company continues the same dividend policy what they had during founder. What the dividend policy during founder? 20% dividend and 80% what? Retention. Now after founder party we said 60 dividend, 40 is what? Retention. Suppose they continue to follow what? 80% retention and 20% what? Dividend policy. What happens to the share price? Why is the next question? In that also one important discussion is going to be made. Let's do the calculation. Write down part D or E? D. Wait, part D. The last part D. Okay. Are you all keeping track of the summa? Can I say it now? Part D. Share price. Part D. Share price if 20% payout is maintained. Share price if 20% payout is maintained. Share price if 20% payout is maintained. Instead of declaring 6 pounds dividend, I am going to declare only how much? 2 pounds dividend. Yes or no? Now write down P0 is equal to what is a dividend here? 2 pounds. Earlier I was declaring 6 pounds after retirement, but still I am going to return only what? 80 and declare only 20%. 2 pounds dividend into 14% minus what is the growth rate without founder here? 6%. 2 pounds divided by 14% minus 6%. 2 pounds divided by 14% minus 6% is equal to how much it is here? Pound sterling 25. Pound sterling 25. Pound sterling 25. A very important discussion is going to be made with this. Now, can we start or not? Now, let us start discussing. No need to copy. Participate. Okay. Okay. See, without founder, I can find projects giving 15% return. Only how much rupees? 8 lakh. Without founder, yeah? Founder retired. In that case, they can find out projects giving IRR of 15%. Only for how much rupees, yeah? 8 lakhs. But I am retaining 16 lakhs. I am retaining what? 16 lakhs. I can find project only for 8 lakhs, but I am retaining how much of their money? 16 lakhs of their money. Respond, yes or no? That means 8 lakh cash, idle I am keeping. I am sitting on cash. I am sitting on what? Idle cash. I neither invest nor return. That is why the share price has what? Dropped. Let's see what is the effect of that in detail. Can I say or not? Now, see, number one, I am investing how much lakhs? 8 lakhs. Even though I retain your money 16 lakhs, I can find out projects only for what? 8 lakhs. I am investing how much money here? 8 lakhs. And what percent return? 15% return. Just take an example and tell me 15% return on 8 lakhs. What amount here? 1,20,000. The new return is 1,20,000. Yes or no? This is in addition to what I am already earning. This growth in return. Are you follow what I am saying? How much I say? 1,20,000. Now, next is return on equity. This 1,20,000 rupees I am earning, and how much investment? 16 lakhs, because the money which I am keeping is not 8 lakhs. The money with me is how much? 16 lakhs. I keep your money worth 16 lakhs and earn for you how much? 12 lakhs. That means the return on equity being how much percentage? 7.5%. Respond. Are you following or not?
Yes, sir.
In that clarity, in that case, the growth rate will not change. The B is how much? 0.8, and what is the return here? 7.5 gives how much percentage here? 6%. Gives you what? 6%. What I want to tell you is, more I retain, more I grow. Yes or no? Other we are having the principle in the garden or not? More I retain need not be more growth, because how much I retain alone is not important. How much I earn and retention also is what? Important. If I retain and don't earn, my return gets diluted. I earn 1 lakh 20 by investing how much? 8 lakh. Don't say I'm earning 15% IRR because I'm earning only what? 7.5% IRR because the other part of the fund is kept idle giving me what? 0% return. The return gets diluted by having an idle cash. Are you following what I'm saying? That is why nobody accepts what? Idle cash. If you have investment, invest. Otherwise what? Return. In this case, due to founder 25 pound share price drop, I can accept it. It is an act of God. It is a situation. It's only what? Situation. Nobody can say founder should work for 100 years for shareholders. Yeah, it's not related to shareholder. He requires retirement. So that is not something bad about the company because it has happened. It is environmental uncontrollable. It is not. But from 75 to 25, the share price dropped. Now, tell me why it has dropped by 50 pounds? Yeah. Because of a wrong dividend policy. Because of what? Wrong dividend policy. If you don't have a opportunity, if you don't have what? Any investment opportunity for your fund, don't sit on cash. Please declare what? Dividend. If you sit on cash, what happens? The company share price will crash from 75 to what? 25. This can be avoided through a proper payout policy. Are you following what I'm saying? That is why the optimum payout should be how much percent? 60% and not that 80%. If I continue the old payout policy and unnecessarily keep the money in my bank account or current account, the share price will surely fall because keeping idle money dilutes my return on investment. Return diluted, retention increases, the growth cannot increase. I cannot say I'm going to grow by retaining more. Yeah, I can grow only when I want. Invest retention. Everybody follow what I am saying? This is what has happened in the last part of the question. Please tell me yes or no. Now. Up to this you are copied, huh? 25 pounds copied or not? Write down notes. Write down notes. Write down notes. Point number 1. The company retains, point number 1, the company retains how many pounds? Tunga, the company retains how many pounds? 16 lakh pounds. Company retains 16 lakh pounds, but invest only 8 lakh pounds. The company retains 16 lakh pounds, but invest only 8 lakh pounds. But invest only 8 lakh pounds at how much percent return? 15% return. But invest only 8 lakh pounds at 15% return. Point number 2. Return is equal to, point number 2, right? Return is equal to 8 lakhs into 15%, 1 lakh 20,000. Return is equal to 8 lakhs into 15%, 1 lakh 20,000. 8 lakh into 15%, 1 lakh 20,000. And return on equity is equal to, and return on equity is equal to, fill in the blanks. 1 lakh 20,000 divided by 16 lakhs. Now the money with me is how much? 16 lakhs. 1 lakh 20,000 divided by 16 lakhs is equal to how much percent? 7.5%. Are keeping the money to earn 7.5? Yeah. They wanted 14. Yeah. Giving them only how much? 7.5. Exactly almost half you are giving. Yes or no? That's why the share price has dropped by what? 50 rupees. So it is going to be 7.5%. Next. Point number 2 or 3? 3. G is equal to B into R. This is given by question A. Understood? G is equal to B into R. And the last line of the question is calculated na. G is equal to B into R, which is equal to what is B? 0.8 into R is what? 7.5. 0.8 into 7.5 is equal to how much percent? 6%. Is equal to 6%. G is equal to 6%. 0.3 or 4? 4. Just by increasing retention, growth cannot be increased. Just by increasing retention, growth cannot be increased. For growth to happen, the retained earnings should be productively invested. For growth to happen, The retained earnings should be productively invested. For growth to happen, the retained earnings should be productively invested. The retained earnings should be productively invested. If the company sits on cash, normally this word is used toward the market. Sitting on cash means what? In our water tank and all, in the house, we keep cash, black money and all, people keep or not? I don't keep here, people keep, okay. Believe me, yeah, okay. Getting recorded, understood now? Believe me, I'm just giving an example, okay. So, how that is means are sitting on cash, not able to invest elsewhere, just what? Keeping the cash and counting it, okay. In old movies, they count the cash in the bureau or not. Like that, if you sit on the cash, what happens? You don't get any growth, okay. What I declared, just what I said? If the company sits on cash, if the company sits on cash, the idle fund dilutes the return on equity. If the company sits on cash, the idle funds dilutes return on equity. The idle funds dilutes return on equity, reduces dividend. The idle fund dilutes return on equity, reduces dividend, and consequently the share price. Reduces dividend and consequently the share price. Reduces dividend and consequently the share price. With this, we have completed this discussion about all the dividend models, including the case study. Okay. What is left is only buyback. Chapter not over here. Buyback is left now. See. Okay. Stop talking, please. We had discussed Walter, Gordon, residual dividend policy. 4 models discussed or not? Rights issue, different area altogether. Please. Okay. Out of all the 4, who is right? Walter, Gordon, or residual? Every model gives you one idea about what to do with the profit. Understand? Now, please. Nobody is wrong. Everybody is what? Correct in their own way. In other words, when you decide on a dividend policy, this is a case study problem, na? Like that. Every company will be faced with this situation. When you decide on what? Dividend policy, one should rationally decide. One should decide keeping all these theories in view. Okay. Every theory contributes to decision making in one way or another. Let us see in nutshell what each and every person tells you for dividend declaration. Can I say? Now, I'll say one by one. Walter says, when R is more than KE, what Walter says here? When R is more than KE, please invest on your own, don't give to shareholders. When you give the money to shareholders, the company invests back the money at KE. If you are having a more better investment, invest at what? R. So Walter recommends that when R is greater than KE, don't declare dividend. Please what? Retain the money. Is a suggestion given by the Walter. Yes or no? Yes, sir. But Gordon cautions saying that just because R greater than KE, please don't retain the full money and all, because more you retain, the KE will increase. Right? So, in the case, for all R, the all KE, all retention, the KE may not be what the same. Please bring the risk angle also into account when declaring dividend. You may have a good project for the entire 20 lakhs, plus don't do it for entire 20 lakhs. Give some money as what? Dividend, because if you read the entire 20 lakhs, your KE may not be 14, may even become what? 16, making the R unviable. Are you follow what I am saying? So the Gordon brings a risk angle into retention is the contribution of Gordon. Yes, sir. Okay. Third, Walter and Gordon believes that I can do new investment only with retention. Modular Miller says, no, not at all. Even without retention, one can do what? Project. If the projects are good, anyhow the company will be what? Doing it. Either by borrowing money or going for what? Fresh issue. Declaring dividend, declaring dividend, raising fresh issue, or borrowing money, or using retention, all are what? Effectively same. He is what Modular Miller argue. He said, don't stop your project because of dividend policy. In spite of dividend policy, still the company can what? Continue the project. He is what Modular Miller gives a new angle. Are you following what I am saying? Yes, He does not prevent you by saying only should be what? Investing through retention. When invest even through what? Financing, equity as well as what? Borrowing, capital structure, dividend policy will not affect the share valuation is what Modiglian Miller said. He may not be true perfectly, but his logic is also to some extent applicable. Yes or no? Finally, residual policy says that you have to maintain a constant capital structure. Just because you have good project with borrowing, don't go for levered investment and all. It creates risk for the company. Please maintain what? Constant capital structure. If given a choice between retention and new issue, always go for what? Retention, because new issue has got what? Its own cost of flotation, etc. Is what residual dividend policy recommends. Yes or no? All this a company should keep, and everybody understands one thing. All four theories are certain that if you don't have any investment, give the money back. Don't sit in what? Idle cash. No theory recommends what? Idle cash. If you don't have any other use for the money, give the money back as what? Dividend is what all the theories unanimously recommend. This is how a company should think while making a dividend policy. Are you having the full framework or not? In the last 4 minutes, the entire chapter discussion till now, yes or no? To make you believe these 4 points only, we had what? So many theories, so many formulas, etc., etc. Everybody following out in the structure of a dividend policy chapter. Everybody have the clarity or not? In the course of this chapter, we learn lot of share valuation formulas also. One is P0, Walter is what? D plus R by KE into E minus D divided by KE. And what is Gordon formula? E into 1 minus B divided by KE minus BR. What is the formula for Modiglian Miller approach? NP0 is equal to P1 into N plus M minus I plus E whole divided by 1 plus KE. Single holding period share valuation formula P0 is equal to D1 plus P1 divided by 1 plus KE. P0 is equal to EPS by KE is what? The constant earnings approach, or P0 is equal to EPS into PE ratio. Another way of valuing the shares. And B is nothing but what? Retention ratio. G is equal to BR. Like there are so many issues through formulas also has been learned in this chapter, dividend policy. Everybody having the clarity or not? Now, two other issues only pending. One is buyback. One is what? Buyback. And second is Lintus model. Lintus model is simple, nothing greater. Not so great. Okay, so we'll be discussing that in 1 minute. Lintus model can be what? Completed. But the only concept pending is what? Buyback. We'll discuss about buyback and then go for the Lintus model. Can I proceed or not? Now, give the heading buyback. Why you are shouting? 8:30 you don't shout here. Then you shout at 6:15 when I enter. Okay, I cannot cancel classes. Now, it is too atrocious to call off at 8:30. Okay, give the heading buyback. Give the heading buyback. Please. Okay, I forgot before that what I discussed, conclusion of the model should be written or not, that only gives you a, why I am discussing the last point is, it may be helpful in reading any case study type of problem and interpreting. Okay, write down. Conclusion from all the dividend policies. Cancel paniya, okay. You can buy back and cancel shares or keep the treasury shares. No, cancel it. We'll come back later. How many times you cancel everything while doing wrong now? One time you cancel. I forgot. Now, okay, write down first. Okay. Point number 1, please. Point number 1, please. Don't talk. Okay, if you want, give the heading. Yeah. Conclusions from all the dividend policies. Conclusions from all the dividend policies. From all the dividend policies. Conclusion from all the dividend policies. Point number 1. From Walter, we can understand that. From Walter, we can understand that the company should retain and reinvest. From Walter, we can understand that the company should retain and reinvest when R is greater than KE. The company should retain and reinvest when R is greater than KE. Point number 2. Gordon brings risk angle into retention. Gordon brings risk angle into retention. Just because R is greater than KE, just because R is greater than KE, we cannot recommend 100% retention. Just because R is greater than KE, we cannot recommend 100% retention because the shareholder will perceive company with high retention to be risky. The shareholder will perceive company with high retention to be risky. The shareholder will perceive company with high retention to be risky and increase their KE. Company with high retention to be risky and increase their KE. This is what is the contribution of Gordon. Are you following or not? Next, point number 2 or 3 here? 3. MM states that a good investment proposal need not be abandoned. MM states that a good investment proposal need not be abandoned just because dividend is declared. A good investment proposal need not be abandoned just because dividend is declared. Because it can alternatively finance through. Because it can alternatively be financed through. It can alternatively be financed through what? Equity issue or borrowings. It can alternatively be financed through equity issue or borrowings. It can alternatively be financed through equity issue or borrowings. Everybody following or not? He proves irrelevance of capital structure and dividend policy in valuation. He proves irrelevance of capital structure and dividend policy in valuation. Last point number 3 or 4? 4. The residual dividend policy recommends a company to maintain what? Constant capital structure. Recommends a company to maintain a constant capital structure. And prefers usage of retained earnings to. And prefers the usage of retained earnings to what? Equity issue. And prefers the usage of retained earnings to equity issue for project financing. And prefers the use of retained earnings to equity issue for project financing. Everybody, are you comfortable or not? This is what all the 4 theories have indicated to us. Can I proceed? Now we can write buyback, share buyback. We are writing share buyback. Okay, please. Shh. Take question number 14, please. Take question number 14. See, we already discussed that when company is having a surplus cash, what do you mean by surplus cash? Cash for which they cannot find any investment opportunity. Can they keep it or give it back to shareholders? Give it back to shareholders. That is agreed in all the theories. I should not keep surplus cash. I should return the money back to what? Shareholders. If I don't have any investment opportunity, right or not? No. There are two ways in which the surplus cash can be returned back to the investor. One is by declaring dividend. One is by declaring what? Dividend. The cash can be distributed to the shareholders what? Dividend. There is another way also. It was very popularly followed, mainly in the last decade, 2002 or 2008 or 9. There was a very popularly followed technique for various reasons. Why it is followed, we'll be discussing in the next class elaborately. But another route in which the money can be given back to the shareholder is called as buyback. It is called as what? Buyback. Buyback means I can give you your money back and take the shares back from you. Are you following not? I can give you your money and then what? Take the share back from you. This is what we call as what? A buyback option. Are you following not? Now, which is good here? Declaring dividend or buyback? Financially, we are going to prove that both are equally good. Both are what? Equally good. The wealth of the shareholder will not change whether I distribute the surplus cash through what? Dividends or through what? Buyback is what first point I am going to prove you through this particular question number 14. Everybody following in order? So, what happens is, I have suppose some cash, 1 lakh rupees cash is there. I can distribute the cash to you as what? Dividend. Or the other option is, I can give the 1 lakh rupees to you back, but I can purchase what? The share from you. Yeah, otherwise, company is reinvesting in its own share. When I have 1 lakh rupees, suppose TCS is having 1 lakh rupees, yeah, can buy Infosys share. It is an investment. Yeah, TCS is having what? 1 lakh. For example, it is having some money, 1 lakh is having. He is going to want to buy another company's share to make an investment. So now, he can also invest in his own share. That is what we call as what? Buyback. Okay, here there are two options for the company, just for the sake of telling the theory. Okay, when the company buys back the share, suppose I give 1 lakh to you and buy back 2,000 of your shares. Okay, what happens is the number of shares of the company reduces. Yes or no? The outstanding shares can reduce. This 2,000 shares, the company can cancel. The company can what? Cancel the 2,000 shares. Or the company need not cancel the shares, then keep it as a treasury shares. It can be as what shares here? Treasury shares. Heard it or not? What happens is, see, when I say share of a company, I can say like this. There are two types of shares the company will be having. Outstanding shares and then what? Treasury shares. Company is having a issued shares of 1 lakh. Take an example. How many shares here? 1 lakh. The issued share is how much here? 1 lakh. Issued capital is 1 lakh shares. In that 1 lakh shares, suppose the company buys back 2,000 shares. How many shares here? 2,000 shares. And does not cancel it. And does not what? Cancel it. In that case, what happens is that 1 lakh shares has got two investors. One is outside investor. Second is company itself. See. Company is having how many shares? 1 lakh shares. All the 1 lakh you are having. Suppose I am the company, my shares, you are having the 1 lakh shares. Now I say today the outstanding shares is 1 lakh because the entire 1 lakh is held by outsider. Yes or no? What I do is, I am the company, I buy back some shares. I buy back some shares. I give you money and get the shares. I am investing in the share or not? I give you money and then what? Get the shares. I get back 2,000 shares. Now tell me, company has how many shares? The company has how many shares? I can say, if the company does not cancel its shares, does not what? Cancel its shares, the company still has got what? 1 lakh shares. But out of the 1 lakh shares, the outstanding share is how much? 98,000, and the company being its own shareholder is how much? 2,000. Company holding its own share, they call us treasury share. They call us what? Treasury share. Why they keep it? Because later when the share price increases, he can reissue and make a profit. Are you following? Issue is called as what? A treasury shares. Okay. Now understand that for the public, for all practical purpose, the share is only 98,000 because dividend will be given only for what? 98,000 shares. Voting will be taken only for what? 98,000 shares. Rights issue only for what? 98,000 shares. The 2,000 shares, instead of cancelling it, they keep it as what? Treasury share. It is forming part of the issued capital. When they want, sometime later, they can what? Reissue. That is one of the options called as what? Treasury shares. A company will be having. Are you following not? In AS 3031, there will be accounting entries for what? The treasury shares also. We will be discussing in the accounts class. Just I am saying, this is what the meaning of what? A treasury share. Okay. Now, the issue here is, whether they keep it as treasury share, anything, but I want to prove here that dividend and buyback are equally good. Nobody can say dividend is better than buyback. Financial reasons, both are what? Equally good. Then later you can say what advantage of buyback, advantage of dividend in the next stage, tax purpose and other things. But mainly dividend and buyback are what? Equally good financially without bringing any other extraneous factors into picture. Are you following not? So our proof is going to be only aimed to that particular end through this particular question, question number 14. Everybody following or not? Let us see how the question number 14 should be answered. A very famous problem in buyback, almost there in every textbook. Can you start or not? Now. Tell me. Before I start, I want to too many things discussed now. Consolidate. Number one, I have a surplus cash. What I will do? Return back to you. How can I return back? Dividend or what? Buyback. Both ways the cash is going to be distributed. When you buy back, what I going to do with the bought back shares? Cancel. I can just what? Cancel. In that case, the number of issued shares itself becomes what? 98,000 only. Or what I can do? I can keep it as what? Treasury share. In the issued share will be 1 lakh, but the outstanding share will be how much? 98,000 only. The treasury shares can be reissued anytime which I want once the share price increases. Now, which is good for the shareholder? Buyback or dividend? Without bringing any other fact like tax and all into picture, normally, financially speaking, in a highly theoretical world, both are what? Equally good. Whether I give you money as dividend or whether I give you money as what? Buyback is equally good for the shareholder is what I wanted to prove in question number 14. Are you following the discussion? Now, take question number 14. And there's also an income tax amendment that has happened for what? The buyback of shares. I'll just tell you about it in the next class. Can I proceed? Now, take question number 14. Y Limited had issued share capital of 1 lakh shares of rupees 10 each. Currently selling at 25. Their EPS is 3 per share. They have surplus cash of 50,000. They are considering the following two alternatives. Pay a dividend of 50 paise per share. Use the amount to buy back share. Two alternatives. Find PE ratio, MPS, EPS under the two alternatives. Can we start or not? Now. Okay. Now, today the company's wealth is how much rupees? How much rupees? 1 lakh share into 25 rupees a share is what? What the wealth of the company? The wealth of the company today is 25 lakhs. What is the EPS? 3 rupees per share. In the 25 lakhs wealth, is everything in productive asset? No. In that wealth, 50,000 comprises of what? Idle cash. Comprises of what? Surplus cash. How much pays here? 50,000. The company should keep this 50,000, distribute the wealth, distribute the wealth. How they can distribute? By giving dividend. Or how much paise? 50 paise per share. How many shares here? 1 lakh shares. Or also going for what? Buyback. Right or not? They have to buy back at the market price. Otherwise, nobody will buy back. Market 25 is selling. If you ask for 24, they won't be selling back to the company. So no. Or they can buy back at how much rupees? 25 rupees. Are the two options the company is having. Everybody respond yes or no. Okay. Before I proceed further, I will write the market value balance sheet. I write what balance sheet? Market value balance sheet. Suppose an all equity company. Forget about debt. It is an all equity company. It is having cash, how much rupees? It is having assets. This is called as what? Projects. How much rupees? 24 lakh 50,000. That is why the equity value is how much here? 25 lakhs. Okay. 24 lakh 50,000 is the book value of asset. It is the present value of all the future earnings I am expecting from this asset. Yes or no? And the present value of cash today is what? 50,000 provided I give back the cash. If I keep it, it will become what? Negative. It becomes what? Less, because then I will not be able to earn what they want. Are you understand what I am saying? Now, today cash is there. They will say cash, very good, they will be saying. But if I put in my pocket, they start crying. Yes or no? Either put in a project, yeah, or give it to them. If I show cash, they are happy. If I put in pocket, they become what? Unhappy. Yes or no? So, the cash is 50,000 cash as long as I give it as cash. Now they will be able to reinvest back at what? They require rate of return. If not, the cash value will what? Reduce. That is why they have decided to what? Distribute the 50,000. You know, are you following what I am saying? You should now. When they distribute the 50,000, first as dividend. As what? Dividend. Number one, shareholder share price will increase or decrease. When they distribute as dividend, share price will increase or decrease? Decrease. Because 50,000 wealth gone, the company becomes what? 24 lakh 50,000 company. It's only the present value, the future cash available, current cash gone. It becomes 24 lakh 50,000 company shared by how many shares here? 1 lakh share. The share price will not be 25 rupees. It becomes what? 24.5. Because the come dividend price became what? Ex dividend price. 50 paise balloon busted. Are you following what I am saying? Correct? Now, the bubble has been what? Bursted. It becomes what? 24.5. Imagine what? Will the shareholder cry? Because he got 50 paise dividend. Yeah. For him, in his personal balance sheet, the share was now 24.5. The dividend is how much? 50 paise. He is having the same 25 rupees. He will cry only when he don't know how to invest the 50 paise back. That's our part. It is his issue, not mine. Are you understand what I am saying? In that case, the shareholder will be maintaining his wealth. And how much of it? 25. The dividend is declared. Already said. Yes, sir. Right or not? Now, when I buy back, when I want buy back the share, what happens is, share price will not drop due to buyback. Understand that first. When dividend is declared, when cash goes out, the share price will drop. Wealth has gone. Yes or no? But when buyback happens, the beauty is share price will not drop. The share price will be what? Maintained. Because numerator cash gone, denominator what? Shares gone. The price will be maintained. Are you following? The next advantage of buyback is next year EPS will increase. Now, listen here. I'll say what is happening. Now, 25 lakhs is a company worth now. Now, it has become how much? 24 lakh 50,000. Now, tell me, share price, I am going to buy back. If you understand, I am going to buy back for how much rupees? 50,000. And how much rupees? 25. That means, how many shares? This, are you following or not? Now, share price after buyback is, the wealth is 24 lakh 50,000. But it is not shared by 1 lakh shares. 2,000 has gone. Yes or no? How many shares here? Going to be shared. How many shares here? 98. What is the share price? So 25 per share. Before buyback also the share price is 25. After also what? The share price is 25. Point number 1. Yes or no? There is an advantage due to this. I'll discuss in the next class. Okay, there are a lot of issues inside what? Buyback. But understand that before also 25, after also what? 25. This I cannot say for the dividend. Right or not? Now, point number 2. Not only this, EPS. The company is earning how much rupees profit? Question number, how much profit here? 3 rupees profit per share. For how many shares currently? 1 lakh share. The company is earning 3 lakh rupees profit, yes or no? Next year the profit will drop below 3 lakhs, go above 3 lakhs, same 3 lakhs. Same 3 lakhs because I continue to do the same project, I'll continue to earn the same profit. I am not distributing cash by selling a machinery. I am distributing cash what? Only by using a surplus cash. By distributing surplus cash, profit will not be affected. Now what happens is, what I am earning now, I continue to earn what? In future also, but I'll earn in future the same profit for fewer number of shares. Now the same 3 lakhs which is now shared by what? 1 lakh shareholder will be shared only by what? 98,000. So the EPS will grow. It's or no? So the advantage of this buyback is, the buyback is maintaining what? Market price. Also helps the EPS to what? Grow. The advantage of buyback. It's or no? But ultimately, dividend buyback is what? Same only. We'll prove to the numbers. Are you following up to this discussion or not? There are a lot of issues to be discussed in and around this point, but basic point I'm just putting into your ears. Are you following or not? Now, let me just go for the discussion now. See. Already has been discussed these calculations. Pay dividend. MPS is 1 lakh into 25 lakhs rupees company. What has gone out? 50,000 rupees. What is gone out? Surplus cash has gone out. It has become how many? What company? 24 lakh 50,000 what company? Shared by how many shareholders? 1 lakh share. When dividend is declared, MPS becomes 24.5. Accept or not? The EPS next year will be same or different? Same. Correct? When dividend is declared, EPS will not change because I did not distribute any asset cash. I distribute only what? Surplus cash only. I do the same project. I get the same 3 lakhs. Same 1 lakh share also is there. The EPS will remain what? Same 3 rupees. Now respond yes or no. Now what is P ratio? MPS divided by EPS. The P ratio is 24.5 divided by what? 3 gives you 8.16 times is what? P ratio is a portion in the dividend. Yes or no? They ask you 3 questions. What are 3 questions in the workbook here? Tell me first question is what? MPS, EPS, P ratio. Due to the dividend declaration, MPS will change or will not change? Will change. MPS will what? Drop. EPS will change or will not change? Will not change. EPS remains what? Same. And P ratio is what? 8.16 times. Up to this, are you following? Any correct? No. Did P ratio change or did not change? It has what? Changed. 25 by 3 earlier become what? 24.5 divided by what? This 3. The P ratio has changed. Everybody following or not? Now, next let's go to the next item, that is buyback of shares. Now tell me, buyback of shares. How many shares I'm going to buy back? 2,000 shares at 25. What is the MPS after buyback? 1 lakh in 25 lakhs company, 50,000 gone. It become what? 24 lakh, 50,000 company. Having how many shares here? 98,000 shares. The share price remains same. And what happens to EPS? EPS has increased. So the P ratio is MPS divided by EPS. 25 divided by 3.0612. How many times here? 8.16 times. Everybody, are you following or not? So whether I buy back or don't buy back, P ratio remains same. EPS will change, MPS will change, but the wealth also remains what? Same. I'll prove in the last slide. Can I proceed or not? No. Let's go to the last slide. Up to this first 2 slides, I already discussed in the sheet itself. Can I proceed? Now let's go for the last slide. Now, let's take so many situations. I am a person holding 10 shares. How many shares here? 10 shares. For example, okay. 10 shares you are holding. How much it is? 25 today. Your wealth today is 250. If the company doesn't do anything, what happens? The 250 will reduce. Isn't it correct? Because when I keep idle cash, the present value of the cash becomes what? Less than 50 tomorrow itself. So I should do something or not. Company declared dividend 50,000 rupees. So no dividend or buyback. Let's see in so many cases. First, wealth after dividend. Suppose I am getting dividend. Now tell me, my 10 shares is now 25, 24.5, 24.5. My asset investment is 245 in my balance sheet. You are seeing a personal balance sheet. In personal balance sheet, asset, what is the investment here? 245. Any others comes? Yes, what asset here? Cash. How much you receive as cash here? 50 paise for 10. So gives how much? 5 rupees. Still your balance sheet is only 250. Right or not? Can I proceed? Next. Another option. 2 shares are sold. Now buyback to no purpose. If you want, you can go on what? I can even sell all the 10 shares. I need not sell any share. Buyback cannot be forced. Buyback cannot be what? Forced. Person may buy back, May not buy back. It is only his wish. Are you following what I am saying? In that case, suppose out of the 10 shares, I want to keep 8. I want to sell 2 shares. My decision, I can even sell 3 shares or 8 shares. Yeah, it is different. In my example, I am keeping how many shares here? 8 shares. And selling how many shares? 2 shares. Now tell me, my 8 shares are what? 24. How much base here? 25. Because in after buyback, share price continues to be what? 25. The value of the investment is how much here? 200. Now, my investment 2 shares have gone or not? That's become what? Cash. How much cash I get here? 2 into 25, 50. My wealth is still what? 250. A person says, no, I'm going to sell all the shares. This company is not linked by me. I'm going to sell what? All the shares. How many shares you sell? 10 shares. At what price? 25. What's the value? 250. I'm going to keep all the shares. I'm going to keep what? All the shares. No, nothing is sold in buyback. In that case, what's my wealth here? I hold 10 shares of 25 case, you want 250. In that case, whatever happens, if I distribute 50,000 cash, then the wealth remains what? 250 always is the meaning. Everybody following? It may be through buyback route, or maybe through what? The dividend route. The wealth remains what? Unchanged. Okay, there are more issues to this, but prima facie, are you following my discussion or not? So this is going to be the answer. Please copy the 3 slides quickly. Quickly copy it, yeah? Only copy. Next class, you will come late. You will never copy this. Okay, please copy this quickly. You go early, come late. Okay, then portions will be missed. Copy this quickly. Nothing red. Copy as fast as possible. I distributed cash now. Why earnings remain same? Tell me. Assets are not diluted. Only surplus cash is distributed. Same machine is there. Same profit can be earned in the next year also. Finished? I'm waiting. P ratio, MPS by EPS, last line, 24.5 by 3, 8.16 times. Those not copy, please raise your hand. Please a bit faster. Can I put the next slide or not? No. Finished? Please, don't talk. Those who are not copy, raise your hand. Following up, that end, last far left. Are you all seeing me there or not? Can I have the next slide or not? No. Finish copying up? No. Don't think that giving dividend and buying back here, this one option is what? Other option, okay. Both are different. When dividend is declared, I don't have any option, only to receive it. Buy back now, I can sell it or need not sell it. Those not copy, raise your hand. So tomorrow, as usual, 10 to 3 will be having the SFM class. We'll start mainly with the chapter portfolio theories in tomorrow's class, very important. Another 45 minutes, this dividend will be completed. We'll be starting with the portfolio. 10 to 3 will be the tomorrow's SFM class. No AMA class tomorrow. Okay.